I'm hearing the market scream two things: growth scare, policy mistake. The Fed may be late.
The Fed needs to get going soon, just given that we have seen, I think, some market deterioration in the jobs market.
What we do know is that when momentum slows, it slows quite quickly.
Certainly there's a signal that September will be the first cut, but I think the Fed will still move very cautiously.
I don't understand the let's go really slowly. If the economy is back to normal, get monetary policy to normal quickly.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your trading week started. Wow. Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. And just like that, the narrative flips. We said it on Friday of payrolls with the difference between the Fed having time and running out of it. At 8:30 Eastern time, Friday morning, there was a stampede to the other side of the boat, and that stampede continues. Your scores look like this. Equity futures on the S&P 500 negative by 2.5%. The Nasdaq down by 4. The winner of July, the loser so far in August, the Russ or the small caps down by 3.9. That's the price action at the index level. Take the single names. We'll pick out three. Nvidia, Microsoft, Apple getting absolutely hammered. Nvidia down another 9%, Apple down 8%, Microsoft down by more than 4%. That's the stock market. The good news in the bond market is doing what it's meant to do. It's rallying. We had a 2-year. The yield moved 50 basis points on the week last week. We're down another 9 at the front end, 379. On a 10-year, down 376. So how did we get here? We know how we got here. The data was weaker than expected. We had ISM manufacturing. Jobless claims on Thursday moving in the wrong direction. On Friday, payrolls definitely moving in the wrong direction. So we have to ask the question, how vulnerable are we to this whole story flipping in the other direction? So look at the week ahead. I want to circle two things. I want to circle the ISM services read a little bit later on this morning at 10 a.m. Eastern time. And I'd like to circle jobless claims on Thursday. For all this talk of 50 basis point cuts, the Fed delivering an emergency rate cut, we'll put some real big question marks around those stories. And I have to say, Danny, we've got to ask ourselves at 10 a.m. Eastern time, if we get a hot ISM service, a good one, a good read, how quickly does this story flip in the other direction?
Well, the concern is that the liquidity squeeze is so bad right now, it's hard to actually know where reality is. If people genuinely think we're going to get a Fed cut in 1 week, because that seems crazy just listening to the most recent Fed speak. The issue, though, is even though the move is unreasonable, it doesn't mean that it can't become reasonable. If you have this feedback loop where the equity market sells off, people price in an emergency cut, the Fed emergency cuts, everyone thinks that there's a recession, so they cause a recession. That's the fear I think is playing in people's minds, but that will have to do with how long this sell-off continues for.
We've got to frame how quickly all of this happened, how quickly things have moved, and also how quickly things maybe have overshot as well. Think about where we were at the start of July. July 2nd, Sintra Portugal Chairman Powell. This was the quote. Because the US economy is strong and the labour market is strong, we have the ability to take our time and get this right. That was July 2nd. The payrolls report dropped on August 2nd. Are we sitting here and saying things have changed that much in a single month?
But the thing is that this market was so built up around that. Again, this is what I struggle with. What is reality in this market and what is just panic and what is just selling? Because by all accounts, the Fed in the recent days has been very calm too. Not even just in July, but the presser. Powell was very calm despite journalists lobbying very dovish questions at him. You had Goolsbee talking to Mike McKee saying that it's just 1 month. It doesn't make a difference. You have so many people looking at the jobs report saying, something about it looks weird. Is this just the weather impact? So again, how much of this is just VAR shocks, people getting stopped out, and then you have these odd market moves?
Speaking of odd market moves, nothing calm about what's been developing over in Japan. And I have to say that this is a continuation of the story that started last week on the Nikkei 225. We closed lower by more than 12% overnight in Tokyo, Japan on the Nikkei 225. The biggest one-day move lower since 1987. In the FX market, dollar-yen, we've gone from talking about the 160s to the 150s to the 140s in just a couple of weeks. We trade right now in that currency pair at 142.39. We're negative on the session by 2.8%. Some vicious yen strength in this market. The broader story looks a little something like this. Equities doing badly, bonds doing better. A rally in treasuries pulling yields lower by another 3 or 4 basis points on a 10-year, 375.47. The dollar weaker across the board. The euro stronger, reclaiming a 109 handle, 109.41. That currency pair firmer by 0.25%. And just to underline the fact that we're talking about a growth shock here, We've got geopolitical risk on the table, and yet still crude is pulling lower. Danny Berger, 71.85 on WTI this morning.
It is remarkable because oil had somewhat held up last week. Sure, it was slightly weaker, but that geopolitical concern, to your point, made it go faster. And that's when you say, out of all of the things that can go wrong in this market, out of all of the things that we're worried about, it's clear that the growth scare is front and center. And that's an issue, again, because you get this feedback loop going, especially with the yen. If you get the yen appreciating, you get rates coming down, the rate differential between the U.S. and Japan shrinks, and then that appreciates the yen even further. You got to ask, how does it stop?
It's taken on a life of its own, and it's feeding on itself. What's the circuit breaker for all of this? Coming up this hour, we'll catch up with Russ Koesterich of BlackRock as the stock market sell-off continues. Earl Davis of BMO on the potential for an emergency Fed rate cut. And Nela Richardson of ADP on why it's too soon to start talking about a hard landing. We begin with our top story. US growth concerns igniting a global equity market sell-off. Russ Koesterich of BlackRock writing the following. We have been trimming risk since June. For the time being, the market is likely to treat bad news as bad news. And Russ Koesterich, we got some bad news on Friday, so let's talk about it. I want to take a giant step back, just away from all the drama, the frenzy, the hysteria, and go back to July 2nd. Chairman Powell, Sintra, Portugal. The economy is strong, the labour market is strong, we have the ability to take our time and get this right. Did things change that much Friday morning at 8:30 Eastern Time?
Well, good morning, Jonathan. I think this is the right question. My simple answer is no, I don't think they did. I think Danny was right a moment ago. This says as much, probably much more about market positioning as it does about how much the economic data has changed. So just two things to consider. First of all, it wasn't that bad of a labor market report. It was only about a year ago that we thought the natural pace of job growth for this economy was maybe about 100,000 a month. And we've really learned over the last year it's higher than that because of the increase in labor supply from immigration. But the reality is we're still printing, call it, an average of 140, 150,000 a month. That is above what we thought was a trend pace just a year ago. So not an awful number, a soft number, not awful. The other point in the bond market, and more particularly the short end of the curve, think about how much market expectations have swung around the last 7 months. We started the year with the market convinced the Fed was going to cut 7 times. You go back a couple of months, the market was convinced the Fed wasn't going to cut at all. And now we've got a narrative built up where they're going to do an emergency cut or go 50 bips in September. So I do think a lot of these gyrations are more about the market and positioning than the change in the economic data.
So, Russ, let's build on that just a little bit more. I went through the week ahead. I circled 2 things. Jobless claims on Thursday, ISM services a little bit later this morning. Let's just say at 10 a.m. this morning, we get a decent ISM services print, Russ. Do you think that's sufficient? Is that enough to flip this story the other way all over again?
Probably not one number, but I think it would definitely be a step in the right direction. I think you're exactly right also to focus on the services number. Now, again, as you pointed out a few moments ago, this all began Thursday morning with a weak ISM number, and it was weak. But the reality is that was the manufacturing read. We've already in the last few years had a pullback in the housing market. We know the consumer softening, but this is, as you know, a service-led economy. So if we get a confirmation that the service sector is holding up okay, it doesn't mean that the economy is not moderating. It is, but it does start to undercut this narrative that's taking hold literally within 72 hours that suddenly we've gone from a soft landing to an imminent recession.
Well, given that quick flip, Russ, what distinguishes the difference between a sell-off that you want to step out in front of and one you want to let run?
Well, I think there are a couple of things. The first of which is we do have to look at the data. Is the data confirming the market narrative? I think, as you've both suggested right now, that the market move looks very, very extreme. Positioning was extended. You've got to let that clear out. But you've already seen pretty significant correction, and there are going to be parts of the market where there's long-term growth that start to look attractive. You've seen the NASDAQ already correct over 10%. Semis and many of the AI themes have corrected 20, 25%. Again, I wouldn't wade in this morning with both hands, given how much we're going to see volatility until the market gets something to confirm that it's not as bad as it thinks. But some of the excesses, actually a lot of the excess that we were all talking about a month ago, that's starting to get corrected.
If you think about the last time you had a market sell-off to this magnitude, you have to bring up March 2020, Russ. And in that period, it was tech that acted as a ballast in the equity market. That's not happening this time around. You can argue that a lot of the sell-off has started with tech and some of the disappointing earnings. So is it different this time? Has the damage already been done in this sector when you see hundreds of billions of dollars in single stocks swinging around day by day?
Well, I think it's reminded people that, look, a lot of these names, they ran a tremendous amount, the AI names, the semi names on the AI theme, which got very, very crowded. But, the tech thing is interesting. So tech is sold off on the notion that, first it began in mid-July, it was a funding source for the small cap. And the narrative then was the economy is great. We've got a Goldilocks soft landing. Rates are going down. Let's buy the parts of the market, i.e. small cap, that are most sensitive to rates going down. But the reality is tech is also rate sensitive. And in addition, if we do start to think that, if nothing else, the economy is going to be softer, some of the trades that people were running into in July, the small caps, the banks, some of the lower quality trades, that doesn't make sense in an economy that's moderating. If anything, you're probably going to be more inclined to look for a higher quality, revenue consistency, earnings consistency. Where do you find that? You find that in a lot of the mega cap tech names and some of the healthcare names. So I do think you're going to get to a point, unless you do believe there's a recession, where some of these names start to make sense again.
So, Russ, I understand you can't do single names, so I'll just do a couple. Myself, JP Morgan in the pre-market's down about 3, Bank of America's down, Citi's down. Regional banks had a tough time of it on Friday. That's the banking story. Tech's getting hammered too. Out of these two industry groups at the moment, Russ, you saying look to pick up the pieces in tech and avoid what's taking place in financials. Don't step in right now.
Well, I'd qualify that a little bit. I do think some of the large money center banks, are interesting. I think some of the smaller regional banks, that I think the regional bank index at one point was up 22%. Again, that's a strange play to make if we think the economy is starting to soften. So I wouldn't necessarily be bottom fishing there. But yes, I do think some of the mega cap tech names, some of the high quality healthcare names, some of the pharma names that have really been beaten up, these are going to offer some good long-term value because, again, all the trends we were talking about 2-3 months ago, as trends that are going to go on for 3, 4, 5 years, they're still in place. We're still seeing tremendous CapEx spending. I don't think that necessarily changes, and these stocks are a lot cheaper than they were a few months ago.
Russ, just before you go, I just want a base case from you. Base case expectation now for the Federal Reserve. It feels like a very long road to September 18th, which is when the Federal Reserve next meets. That's the next scheduled meeting. Russ, what's the base case for you now, you and the team?
Look, I still think, we were talking about 2 to 3 cuts. I think I would still keep that as our base case. Obviously, if the data softens significantly in the next 6 weeks, they have the latitude to cut more given how high real rates are. But I wouldn't rush to assume that until we see some further deterioration in the data.
Russ, it's good to hear from you, sir. Russ Koesterich there of BlackRock, following some wild moves in this market from equities to bonds to foreign exchange and worldwide into Japan. Nikkei 225 getting absolutely hammered. There's been some big calls in the last couple of days. Immediately after that jobs print, Danny, we saw Andrew Hollenhorst of Citi go to a 50 basis point cut call for September. Saw Mike Ferroli of JP Morgan do the same thing. We'll catch up with Andrew a little bit later this morning.
You also had Goldman Sachs raising the recession probability from 15 to 25. But let's be honest, 25% is still not very high. And I think that's where we have to really coalesce around some of these calls. Sure, they're calling for 50, 50, 25 in terms of cuts. But again, that's not something like an emergency cut. That's not something like the sky is falling. And I got to be honest, John, a lot of these moves this morning are just that. They're the sky is falling type of trades.
That's what it feels like. We're down by 2.7% on equity futures on the S&P 500, just off session lows. Let's take the opportunity to get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hakez. Hey, Yahara.
Hi, John. We start with oil trading lower, extending its losses to a new 7-month low. Brent futures are now trading below $76 a barrel, erasing this year's gains, while West Texas Intermediate is now below $72. This comes as the market braces for a possible attack from Iran and regional militias against Israel in retaliation for the assassinations of Hezbollah and Hamas officials last week. Cryptocurrencies are plunging this morning. Bitcoin briefly traded below 50,000 earlier. The sell-off adding to a more than 13% drop last week. That was the biggest plunge since the FTX exchange imploded. U.S. exchange-traded funds for Bitcoin suffered their largest outflows in about 3 months on Friday of last week. And there's a debate about the next presidential debate. Donald Trump said in a social media post that the previously scheduled debate to be hosted by ABC News was terminated once President Joe Biden dropped out of the race. Trump presented a counterproposal to Vice President Kamala Harris to face off on Fox News 6 days earlier. Harris says she plans to be at the ABC debate on September 10th. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara again in about 30 minutes' time. Up next on the programme, the Japanese yen sinking Japanese stocks.
If the Fed's cutting, I don't think we can be above 140 next year. If they're cutting a long way because there's a serious slowdown, then yeah, we can go back to 120 and see where we go from there.
We're at 140 already, 142 this morning. Dollar yen gapping lower by 3%. A conversation up next, live from New York this morning. Good morning. Live from New York City, welcome to the program. Let's get you some price action. Equity futures look like this. We're negative by 2.8% on the S&P 500, down more than 4% on the Nasdaq. The sell-off continues on the Russell. Last week for the Russell, worst week for the small caps, going back to spring 23. Spring 23, you all remember March 23. We were talking about bank failures in America. It's that kind of shock, growth shock, taking place this time around. I want to talk about equities just briefly. Stuart Kaiser of Citi, reduce exposure. Our established view has been to run long US equity risk until the US labour market shows confirmed weakness. That is now under question. And that is the question. We get jobless claims later this week. So next stop for this conversation, ISM services later this morning, 10 a.m. Eastern time, the one to watch. Switch up the board and turn the page and get to the bond market. And let's talk about this monster rally we've seen at the front end of the yield curve. The 2-year making a move of 50 basis points plus, Danny Berger, just last week. After a 50 basis point move, I think, in the month of July, and we're down another 12 this morning to 375.
This pendulum swing in the market has been constant and painful. Russ Koesterich talked about it there, this idea that you entered the year thinking that we'd get 6 cuts. That was the extreme that you wanted to fade. And then we went to no cuts. That was an extreme you wanted to fade. Now we're in the land of talking about 50 basis points cuts, an inter-Fed meeting cut 2, 60% odds of that happening. So is this yet another extreme you just want to fade, John?
Some of these consensus trades over the last few months have unwound in such a vicious way. And I think the perfect example of that is dollar yen. It's a break of 142, briefly. 141.99. We're down by 3 percentage points, and we're seeing some vicious yen strength. A move of more than 3 percentage points on the session. That's the story in the FX market. Under surveillance this morning, the Japanese yen sinking Japanese stocks.
If the Fed's cutting, I don't think we can be above 140 next year. If they're cutting a long way because there's a serious slowdown, then yeah, we can go back to 120 and see where we go from there. This is very much a function of where US interest rates are. This was possibly the biggest carry trade that we've ever seen because the Japanese kept still while the Fed hiked and hiked and hiked and hiked.
So here's the latest. The yen extending its rebound against the dollar as concerns mount. The Fed is behind the curve on supporting a slowing US economy. The move unwinding global carry trades and jolting markets around the world. Jeremy Stretch of CIBC joins us now for more. Jeremy, it's rare to sit here and look at a Nikkei 225 that's down by 12.4% at the close, but that's what's in front of me right now. It's rare to see the moves we've seen in dollar yen down from 160 to 140 in a very small amount of time. Jeremy, talk to me about the path of least resistance now, what positioning looks like now we've reset so aggressively, and what the limits are to some of these trades.
Good morning. Well, you're absolutely right. It is an unprecedented state of affairs in the context of the move in those Japanese stocks, but we have seen an aggressive reduction in position pairing even before this week. So we'd already seen yen shorts effectively halved over the course of the last couple of weeks, but I think those have probably been cleared out now. So I think we've got a much cleaner market perspective in this particular juncture. But obviously, as your previous contributor suggested, if there were to be a very aggressive path of monetary easing from the Fed. Now, I think, I was listening to Danny just before he went to the break, where she was talking about the markets being priced for the sky falling in. Well, I don't think the sky is falling in. Yes, we see a slowdown in the US. Yes, we see a recalibration in terms of macro dynamics, but I don't think necessarily we should be getting carried away with that Fed pendulum effect and suggesting that we should be looking at intra-meeting or 50 basis point moves. So I think we've cleansed markets, and I think once we get back to a sort of a 140, the 140 candle, I think, is probably a sort of an extreme or a support point at this particular juncture as we reassess the macro environment. And I think for today, services ISM is going to be particularly instructive, as well as obviously Mr. Goolsbee from the Fed.
Jeremy, if I can just push you on the positioning point for just a moment, and then we can move on to some of that. You say that some of the shorts have been washed out. But is there more that is structurally riding on short yen than we maybe failed to appreciate? Things like using the yen as a funding for going long tech, things like people who are just more structurally short yen?
That's true. I mean, and obviously when we do get to market dislocations and when we do see substantive pockets of weakness in various sectors, then clearly we often have to see a position cleansing in terms of sort of recalibrating those positions and and dealing with particular losses in certain sectors. So clearly, it has been the case that part of the funding, perhaps for the record surge in tech stocks, has been funded out of cheap yen. So in a sense, there is an obvious dynamic in that regard. I think there is, as I say, a story of a slowdown effect, which obviously was the Fed's intention. But I think the market, as is often the case, is overblowing this situation in the near term. Yes, we're seeing a slowdown, undoubtedly. Are we seeing a recession in the US? I don't think we're necessarily there yet. And I think, in terms of those recession probabilities, we should, remember that 25% recession probability is 75% no recession probability. And I think that's the way that we would probably still view the market. But clearly there is still some yen dynamics which are playing out, and that will continue to oscillate in what are relatively illiquid and thin summer markets.
Sometimes, unfortunately, it's good to get a reminder of how percentages work, Jeremy. I think the market needs that this morning. So what stops it? What stops this sentiment down spiral that we're seeing? Is it running out, or, as you mentioned, data coming in stronger this morning?
Well, I think the data, is going to be particularly instructive this morning because, of course, if we go back to the back end of last week, the start of the sell-off was obviously precipitated by the weakness on the manufacturing ISM. And I think the manufacturing data in the US is important. Of course it is. But I think we shouldn't lose sight of the fact of the huge influence of the services sector. Now, we have obviously seen some weaknesses in services over the course of the last couple of months. Now, the market is anticipating a move back into an expansion dynamic in services ISM. Now, will that be enough to arrest the downtrend? Perhaps not, but I think it will at least put an element of doubt in terms of this magnitude of recession risk, which has been amplified by that non-farms reading on Friday, particularly the uptick in the unemployment rate and the discussion regarding the Sahm rule, which obviously was mentioned in the Fed press briefing last week. And I suspect Mr. Powell would rather have an opportunity to recorrect some of his responses, but inevitably I think we're now going to be watching and waiting for not only the data but the 2.5 weeks until we get to Jackson Hole.
We'll catch up with Claudia Sahm a little bit later on this morning. Jeremy, I just want to get to this quote from Neil Dutta. I'd love your thoughts on it. I'm going to share it with our audience. The Fed stepped on a nail. Thankfully, they've not stepped on a bed of nails. What we are dealing with now is the result of monetary policy being too tight. This means the solution is quite simple. Neil Dutta implies this is going to be easy to deal with, Jeremy. The Fed's at 550. It's got a big cushion it can use if it needs to. How easy is it to address this situation?
Well, I think that's true. And as with monetary policy, what we've seen from central banks is during the period that they've been building in a cushion in terms of a safety net to allow them to ease policy in a conventional fashion, not being forced into unconventional policy adjustments. I think the problem from the market's perspective is that we've just had a Fed meeting, and it does seem like an awfully long way away until that September FOMC meeting. As I say, that's why I think Jackson Hole cannot come soon enough for the markets, because they would like to see some recognition from the Fed that policy easing is coming. But clearly there is plenty of latitude and scope for conventional policy easing. But in the context of the Fed pendulum, we are very much in a scenario that at this particular point, markets are getting very exercised not only about the scale of monetary easing in 2024, but the risks or the potential optionality of thinking that the Fed will be forced to move before the next scheduled meeting. But the Fed has latitude, but I think we need to see some commentary from the Fed over the course of the next few sessions.
That Fed get-together in Jackson Hole, Wyoming, just a few weeks ago. Jeremy, thanks for jumping on the phone. Appreciate it. Jeremy Stretch there on that breaking news out of Japan. Dollar yen with a move of 3% in the yen's favour and a move of 12.4% lower on the Nikkei 225, the biggest one-day loss going back to 1987. So many notes dropping this morning from the South Side. Plenty of thoughts. I'll share some of those thoughts with you. Mislav Matejka over at JP Morgan. Here's the take from the team over in London. The investor outlook is still overly complacent. Concentration risk remains high. The VIX has not had a proper capitulation for quite a while, and credit spreads are extremely tight. We continue to believe that international equities will be weakening during the summer. That's what's happening right now. We're down another 2.9% on the S&P 500. NASDAQ futures down by more than 4%. And the loss is picking up, I tell you, on the small caps. The Russell's down by more than 5 full percentage points. Danny Berger alongside me to work through this morning. Danny, the losses last week on the Russell, we were down almost 7% on the week. Terrible week of losses, the worst going back to spring of 23. The Russell was up 10% in July. You know, what's happened? How has the pendulum gone from here to here in just a week?
And there are so many people who, after the Fed started to talk about cuts, were really excited after that Wednesday decision and just jumped on. There was a big rally in the Russell 2000 on Wednesday after that Fed meeting decision. So many people went long the Russell in recent times and just got smacked in the face. But John, I mean, the move, looking at a VIX that's at 50 right now, after it was stuck below 20 for so long, there are so many people who are getting hurt in today's trade, and a lot of it, you just got to wonder how many people are just looking at their winners for the year and selling them because they can't face more losses.
I'm not sure who's left in the bond market that's still short treasuries, because this would have been really painful the last week or so. The 10-year, the yield has been down for 7 consecutive sessions, and you can make it day 8. The 10-year yield's down 5 basis points, but the bigger moves have been at the front end of the curve. We saw this develop in July, down 50 basis points in July. And then it just happened so that last week delivered another 50 basis point move. 50 basis points on a 2-year yield in a single week. That was the move lower last week, and we're down another 12 this morning, down to 375. 41 on a 2-year.
At least you can say bonds are doing what they're supposed to be doing, that we have somewhere in this market we can go to for safety. But that's creating this environment where we're pricing in a Fed cut in the next week, which, again, is kind of crazy considering the calm we've heard from the Fed and the fact that the data isn't that bad. If you look back to other crises in the market, you think about the quant quake, LTCM, when the Fed did step in, the difference that time was the sell-off was about the Treasury market. This time it's about equity. So I don't think we can be as certain that the Fed is going to step in this time around.
These were shocks to the system. Think about the last big shock to the system in the last 18 months. You go back to spring of 2023. We had bank failures. What did the Fed do? The Fed carried on hiking interest rates. That's what the Fed did. Now, maybe you can sit here and say that inflation is so much lower now. They've got a cushion. They should want to insulate the labour market. I want to go back to the Goldman call, and we'll spend some time on the Goldman call a little bit later. Yes, Goldman have lifted recession odds, but ultimately they think it's going to take another jobs number like the one we got on Friday before you really start having a real conversation about 50 basis point moves in September.
I think the only argument you can have today is just that the wealth effect is so bad that they have to cut, that people believe that a recession is coming. They act like a recession is coming, so the Fed has to step in. And we can also debate whether Fed stepping in would make things worse or better. If they come in with an emergency cut, all of a sudden people freak out more because they decide that the Fed is also in panic mode. I'm not sure that's a good thing for this market, but also you need just more than one day of a big sell-off to really say there's a wealth effect happening.
Well, we've had some big moves in dollar yen, so let's talk about this move in dollar yen. Last Monday, dollar yen opened up at 153.82. And here we are right now at 142.08, down by 3%. And if you thought that move was big, just check out Japanese equities overnight. Danny, we've got to keep going back to this. A move of 12.4% on the Nikkei 225, the biggest one-day loss going back to 1987. How many people have come on Bloomberg, come on this program in the last few months and said, I like Japanese stocks, and we've said to them, what happens if dollar yen goes from 160 to 150 to 140 to 130 to 120? And they've said this is not about the currency.
Yeah, they've come on and said that there's corporate reform happening in Japan. Companies are stronger. There are wages picking up, and all of that is a good thing for Japanese companies. But they overlook the fact that Japan's been used for a funding currency for so many different trades, that there is a systematic issue if the Japanese yen does start to appreciate. It's not just about the fundamentals. The fundamentals, by the way, which were based on, I don't know, a lot of tourists coming to Japan, it's not exactly the strongest legs to stand on.
A lot of trades built on top of that foreign exchange market and that currency pair. Under surveillance this morning, the global market sell-off accelerates as concerns over a US economic slowdown intensify. Mega-cap tech names bearing the brunt of all of this, Nvidia and Apple, both seeing some very sharp drops this morning. If you check out shares of Nvidia, we're down by almost 10%. This note came out from Bank of America over the weekend, and they say this: we see any sell-off in this name as an enhanced buying opportunity. We don't get the earnings until month end.
it's scary to step out in front of these right now because of just how long people have been and the fact that they are still up this year. Maybe not Microsoft, that's erased its gains for the year. But from 2022, this is an S&P that's still up some 20%. It's NVIDIA that's still up 833% from 2022. There are going to be people who are still long this thing and are still sitting on gains. That's not something that means that the sell-off at this moment can stop. I mean, there's still plenty of people who could sell.
That sell-off continues this morning. Need to get you an update on the politics as well. Kamala Harris expected to announce her running mate in the coming days. People familiar with the matter saying Harris held weekend meetings with Arizona Senator Mark Kelly, Pennsylvania Governor Josh Shapiro, Minnesota Governor Tim Walz as well. Meanwhile, Harris and Donald Trump differing over a potential presidential debate, Harris preferring a September 10th debate on ABC, while Trump calls for a debate hosted by Fox News a little bit earlier. I think for the politics, you have to go back to Friday. This could well change the election. If that unemployment story is real and not a head fake, and it continues going into November, then the Democrats have got a bit of a problem.
Yes, you can use a corollary for this on the other side of things. When Obama was seeking re-election and they said, OK, the unemployment rate is really high. It's something like 8%. This is bad for Obama. But the trend was down. We have the opposite thing right now, where you could say the unemployment rate, it's not that bad on its surface. It is just 4.3%. But the issue is the trend is up. It's trending in the wrong way. And that's going to be an issue for this party.
We've been heading in the wrong direction for a number of months now as well in that labour market. Check out the bond market. Treasury's surging. On growing bets, the US economy is slowing so quickly that the Fed could cut rates within a week. Earl Davis of BMO is writing this. The weak employment data shows job growth slowing, but the economy remains solid. The Fed didn't cut rates in July, but a 50 basis point cut in September is possible due to the stimulative fiscal deficit. Earl joins us now for more. Earl, let's get into this. Let's take a giant step back. I did that with Russ Koesterich earlier this morning. I think we have to do that repeatedly throughout the whole of this morning. What happened on Friday, Earl, and did it change things enough for you to make some big calls, like some of the moves we're seeing in this market currently?
Yeah, what changed on Friday is that the Fed has been alluding that now it's all about employment, not inflation. So when we got the number that we got on Friday, people ran to the doors, and the door is only so wide. So that's why you get this acceleration of the move. Has it changed things for us? Different time frames, yes. So let me tell you about the short-term time frame. Friday was a very good day for us as active fixed income managers. We were long overweight duration heading into Friday, but not only did we cover that overweight, we started shorting the market now. So Friday, close to the lows, we put on, let's call it 1/3 of our max short. Today, at 370 or better in the 10 years, we're going to put on another third. And then we're waiting for that extension of the sell-off due to stop-loss selling, and we'll put on our last third. We anticipate that'll be this week. We have a high amount of confidence in shorting the markets at these levels for two reasons. One, obviously, treasury supply. But I was a bond trader for 12 years, and what happens in this type of market is you get a lot of corporations looking to extend their issuance of credit of corporate bonds to 10 years because they take advantage of this rally with lower funding costs. Your credit spreads are still historically tight. It is an excellent opportunity for them to get involved in the market. So what happens is they agree with dealers that they want to lock in these treasury yields, and dealers now start selling treasuries to lock in these low rates. That's how they lock in low financing costs before the bond issuance. Tremendous opportunity here to shorten the market, but it could extend.
Oh, just build on that a little bit more, because we've seen a ton of supply from corporate credit through the year so far already. What kind of numbers are you and the team thinking about? How much front loading for the rest of the year are we about to see?
Well, it's a great question. We haven't thought of the exact number, but we do know, and this has been some pushback that we've gotten from clients, and then after our response, they're good with it. We do expect it to be more than the existing demand for buying, which means your credit spreads will widen. However, this is an important thing to remember. When you have these risk-off moments, what you have are people who historically invest in equities start looking to diversify that risk, and they like corporate credit as well. So they mix both of those two things. So we believe there will be additional demand that comes in with new corporate issuance. There are still trillions of dollars on the sideline as well, too, and the economy is doing well. Again, tremendous opportunity here from an active manager's perspective to be selective on the corporates and the credits that you go long. this is what we've been waiting for. We've had valuation discipline for the past 3 months, but it's at these moments where we're adding to credit. We added to credit as well on Friday, and we will continue to do so over the coming weeks.
Earl, does that mean the slight spread widening we've had, and I say slight, especially compared to other risk market moves, something like 8 and 30 basis points for IG and HY respectively, that's kind of it, that it won't get much worse from here?
It will get much worse, but it is still opportunity. It's positive carry and you're doing well. The reason why it will get much worse is because a way to think of being long corporate bonds and long carry, you're actually short vol. So in this market, when vol increases because of what's happening in the yen, carry trades being put out, the equity indices are being rocked a little bit. What happens is vol increases, your credit spread increases. So we do anticipate it to be more. But we do see, because we don't anticipate a recession either this year or next year, that will snap back in once the markets calm down. It's not immediate. And when it doesn't snap back in, you're still earning a positive coupon, positive carry. That's why we're legging into it, so to speak. We're not going all in on credit, but we are starting to add, and we will continue to do so.
What distinguishes the difference between spreads widen, equities sell off, and the corporates having an impact, the corporates acting different and having to respond to that, besides ones that can just sit still through the damage?
But it's a great question. So there's two sides to the coin of corporate bonds. There's me, an investor, so I buy it, I invest. And then there's corporations who actually need to fund the company. So when you get these tremendous rallies that you've been talking about, not only in your 2-year, but your 10-year and your 30-year, this is the type of market where corporates like to fix in their financing costs for the next 5, 10, 30 years. And the reason why is they've seen how high yields have been, last year, the highs of last year, even like July 1st, I think 10-year bonds in the US were testing 450. Now we're testing 370. 80 basis points of lower carrying costs or lower financing costs for 10 years is significant for a corporation. So that's why they look at this side of the equation. And you know what? There will be a lot of dealers that are knocking the doors to highlight the benefits of this. And that's why they get involved.
Oh, just before you go, we're just trying to gauge from investors, people in the market like yourself, how vulnerable this market is to flipping the other way all over again off the back of a firm print on ISM services a little bit later this morning. How are you and the team framing that data point later on today?
Yeah, I don't think it's vulnerable to flipping back, but this is, I'm happy you asked that question. The level in 10 years that we see at the pivot point is 385. So any yield below 385, we are better sellers, with underweight duration. Above 385, we start going long duration. It is our full expectation that we'll test both ends of that. We'll go above 385, but the trend now is definitely lower. But we could see us going much higher as well before we ultimately hit new lows. And that underscores one thing. Our number one highest conviction trade for 2024 coming into the year was volatility. That means, and we're seeing it, and that means the path is more important than the destination. So having ideas as to where pivot points are, where you're underweight, overweight, is the key to making alpha. And that's why we're very bullish on alpha in fixed income and active management.
Oh, this was super smart. It's good to get your thoughts, sir, as always. Good luck this week. Earl Davis there of BMO Global Asset Management after some big moves. He was long volatility. That's exactly what he's got on these screens right now. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. The Prime Minister of Bangladesh, Sheikh Hasina, has resigned and fled the country as anti-government protesters converged on her official residence. This according to local reports. She had faced pressure to resign for weeks following violent demonstrations that have killed more than 100 protesters. The nation is shutting down government and private offices, including banks, for 3 days starting today, and mobile internet service has been shut off. The country will now form an interim government with the backing of the military. Meanwhile, Israel is bracing for possible attacks from Iran and regional militias. This after the high-profile assassinations of Hamas and Hezbollah leaders last week. Prime Minister Benjamin Netanyahu saying over the weekend his country is in a, quote, multi-front war against Iran's axis of evil. Amid the escalating tensions, the U.S. is moving a fighter jet squadron to the region and plans to keep an aircraft carrier nearby to help Israel. Still, the White House is urging Netanyahu to redouble ceasefire negotiations with Hamas. And we're seeing shares of Apple tumbling down nearly 9% in the pre-market as part of this global tech sell-off. But we also learned over the weekend that Warren Buffett's Berkshire Hathaway slashed its stake in the iPhone maker by almost 50%. This part of a second quarter selling spree that saw Warren Buffett's cash pile soar to a record nearly $277 billion. Still, analysts are urging Apple investors to remain calm despite a delay in the company's much-hyped AI rollout. That's your Bloomberg Brief. John?
Yahara, thank you. I guess the real question, Danny, is how much you'd like to buy this morning off the back of this move.
I was thinking, what great timing from Warren Buffett. I mean, I'm sure he didn't think this was going to happen, but good timing for him and maybe bad for everyone who bought what he was selling.
Amazing. Yahara is going to join us again in about 30 minutes' time. Up next on the programme, the long odds for a soft landing.
I'm hearing the market scream two things: growth scare, policy mistake. That is what I'm hearing.
It was screaming those two things loudly after that jobs report dropped on Friday. More still ahead. You're watching Bloomberg TV. If you are just waking up, good morning and welcome to the programme. The scores look like this in the equity market. Equity futures negative by 3 percentage points. There's a rally in the bond market. 10-year yields down by 5. 2-year yields down by 13. The dollar is weaker. The euro stronger. The yen is much stronger. Euro dollar right now 109.40. Dollar yen 142.42. Under surveillance this morning, the long odds for a soft landing.
I'm hearing the market scream two things: growth scare, policy mistake. That is what I'm hearing. The market now fully understands that the Fed may be late in starting its cutting cycle. In the past, I kept on saying there's no reason for the US to fall into recession. I think people underestimated the lagged effects of higher interest rates, and these are hitting in a much bigger way now.
In a much bigger way. Here's the latest. Concerns of a US economic slowdown spreading worldwide after the July jobs report reinforced worries the Fed held rates too high for too long. Nela Richardson of ADP writes this: it's too soon to talk about a hard landing again. It is a bumping out but safe landing for the US economy where inflation continues to abate and hiring increases modestly. It may be the case that in July data, the jobs market is reminding us of what normal looks like. Nela joins us now for more. Nela, it's good to see you. Do you think we are confusing normalization with something more nefarious?
Yes, and to answer that question, I'd like to take you back to July of 2019. The U.S. economy grew employment by 1.3% and created 90,000 jobs. Now let's fast forward to the present. 114,000 jobs, employment growing at 1.6%. This is normal. And the risk of over-exaggerating where we are, which is definitely a cooler labor market, but the risk of going too far in our sentiment is that we will have higher expectations for a Fed rate cut than we're going to get. The Fed will not deliver us from 4.3% back to 3.5% unemployment rate. And if we think that going into that September cut, we're bound to be disappointed in the markets. And that's the concern.
Let's talk about a place where you have some confidence. Do you have some confidence we can stabilise at these kind of levels in this labour market, that we can deliver jobs gains that look like that for quite a while and we don't just sort of head on this one-way track towards negative numbers at some point in our future?
So I'm going to give you an insider's perspective of the labour market. I'm going to give you that perspective because I see about 25 million paychecks every single month, every single week. And we've been looking at the labour market in this really fine-tuned, granular way. And what I will tell you is within all of this, hiring is different now than it was in 2022 and 2023. We are not just replacing workers in this labor market. Remember that revolving door of the Great Resignation. Remember how hard it was to lure workers back into this space. Remember how quickly they left once they got there. Employers are not in that position anymore. They are hiring because and only when they are growing by and large. Yes, of course, some people leave the labor market. There's maternity leave, there's early retirements. But on net, it's real headcount growth, not just replacement hiring. It's a very different space than employers were 2 years ago.
Does that also mean that the labor hoarding that we've seen from companies, keeping on and holding on to employees for fear that they couldn't replace them, that's over?
I think it's too soon to say that.
Okay.
What we have seen in the data is that employees are not leaving as quickly as they used to, that they're staying put, that the turnover rate isn't there. You can see that in the JOLTS report. You can see it in the quits rate. Quits now are back to where they were pre-pandemic, even a little bit lower than they were pre-pandemic. So in that reality, when companies may have overhired, thinking that some of their workers would have left, they are tweaking their headcount at the margins to correct for what may have been a bit of a rambunctious hiring a few months ago.
I wonder, though, when you look at a market doing as it is today, when you look at sentiment turning, is there a fear that corporates are going to be more reactive this time around, that they do have, for a large part, a large labor force because of some of the overhiring that they've done? So when they finally let people go, it's sort of like the beach ball that's been kept underwater and you finally release it, and a lot of people are let go.
Well, to answer that question, let's go back to the data. Let's go to the labor force productivity numbers that were kind of lost in all of that labor data last week. You know, there are more workers and workers are becoming more productive. So in terms of a corporate earnings perspective, having a more productive workforce is actually helpful. It's helpful to earnings. So I'm still in the camp that these are minor tweaks. If you do see a reduction here or there, when we've seen large-scale layoffs, they have typically been in specific investments that companies have made and maybe they pulled back from. But by and large, in order to keep growing, in order to meet those earnings expectations, you have to keep your workforce and you have to make sure they're productive. And that's what we're seeing in the macro data.
As you know, there will be a big get-together in Jackson Hole, Wyoming in a few weeks' time. What do you think the tone of that get-together is going to look like now? Because we've said already this morning, the road to September 18th for the next Fed meeting feels like a long, long way away.
I think they're going to be able, these policymakers, to come together and take a breath. They've been so tactical. Data dependent. Okay, not data point dependent, but very data dependent. Now they can talk strategy, and this sets them up for a conversation that they are going to need to have going into next year about the framework. Remember that the current framework that we've been operating under anticipates a very different inflation scenario than we're in now. That framework where we can let inflation be a bit above the 2% target up to 2.5% on average anticipates a very low inflation rate as normal. We're not in that world anymore. So they have to start going from this data dependence tactical maneuvers in the monetary policy to a more large-scale, big-picture strategic framework. And I think that starts in August.
Is there anything this market could do, though, whether it be wealth effect concerns, the bond market just running away from them, that would make an emergency cut make sense to you?
No. Really, no. Not a 4.3% unemployment rate. What that does is set a precedent that I don't think the Fed wants to deliver. Are we saying that every time that we see an unemployment rate below 4.5%, the Fed is going to have to act? Like, what is the framework? Maybe if there's a strategy around that, a long-term perspective that we can reference, but if it's just a 0.2% move in a statistical estimate, then the Fed is really backed into a corner as you look out over the course of next year when we know economic growth is slowing.
And Nela, this was great. It's just fantastic to catch up with you. Just a cool, calm head of what's happening right now in the labour market, what the Fed may or may not do in the future. The brilliant Nela Richardson there of ADP. Danny, this reflects what we heard from Neil Dutta as well over at Renmac. They've stepped on a nail, not a bed of nails. And the response to this is an interest rate reduction, and you'll get that interest rate reduction in September. Neil's view.
You could even argue that in Wednesday, in their Fed decision, we have to remember that just cutting rates is not the only easing tool that they have. Even just Powell sounding more dovish was enough to get rates to where they are at this moment with the help of some of a sell-off of 3.8%. You could argue that some easing has already been put in this market. They don't need to do an emergency meeting cut. Maybe they just need to sound really dovish at Jackson Hole, and that's enough.
The schedule for Fed speak over the next few weeks is pretty light. I imagine there will be some speeches scheduled between now and the end of the close in the market. We'll see. Coming up next, Sarah Hunt of Alpine, Saxon Woods, Ed Yardeni of Yardeni Research, Claudia Sahm of New Century Advisors, who's become incredibly famous, popular over the last couple of days. We'll talk to Sahm about the Sahm rule and Ed Al-Hussainy of Columbia Threadneedle. All of that still to come. The second hour of Bloomberg Surveillance up next.
I'm hearing the market scream two things: growth scare, policy mistake. The Fed may be late.
The Fed needs to get going soon, just given that we have seen, I think, some market deterioration in the jobs market.
What we do know is that when momentum slows, it slows quite quickly.
Certainly there's a signal that September will be the first cut, but I think the Fed will still move very cautiously.
I don't understand the let's go really slowly. If the economy is back to normal, get monetary policy to normal quickly.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now. Live from New York City this morning. Good morning, good morning. If you were in this market, you haven't had much of a weekend after Friday. At 8:30 Eastern Time, payrolls dropped and quite literally dropped. A big downside surprise in a payrolls report. That upset a lot of people, and now we've got some big calls. 50 basis point cut in September. Citi's Andrew Hollenhorst. 50 basis point cut in September. Mike Ferroli of JP Morgan. What a difference a payrolls report makes. Check out the price action. The negative follow-through is real. Equity futures on the S&P down by 2.7%. On the Nasdaq, we're down by 4. On the Russell, we're down by 4.4. Dig into the Nasdaq. Some of the biggest tech players on the planet dropping aggressively. Big moves on Apple, on Nvidia, on Microsoft. Nvidia right now down by 8.8%. On Apple, we're down 7.5%. The big bull on Wall Street, the poster child for some of these tech AI names, Dan Ives of Wedbush. He joins us a little bit later this morning. Danny Berger, he says this: we're getting inbounds from investors around the world throughout the weekend, asking us if this tech bull market and historic run for tech stocks is over. He says it's not. We view this as just another white-knuckle moment in a multi-year bull run for tech stocks that need hand-holding.
So no black suit for Dan Ives yet. We're not quite there. But you got to talk about timelines here. If you're talking about the short term, it's really hard to step out in front of this when you have so many people who are long year to date and you have all of these short volatility trades that have been put on. It's like picking up pennies in front of a steamroller. The steamroller has arrived by all accounts, and it is painful when it does. The question will be how much longer it lasts.
As we get to this bond market, set up the board, 2-year, 10-year, 30-year, and let's just look at the difference between the 2-year and the 10-year. Just in a commercial break, Danny jumped all over this bond market and said, look, we're within 1 basis point of that yield curve disinverting. The 2-year right now at 375.81, the 10-year, Danny, at 374.35.
My favorite thing about this is all those people who said, look, when the yield curve starts disinverting, that's when you get recession. And everybody who's coming out now and saying, see, look, I was right, it's happening. There's some confirmation bias happening in this market because the data hasn't been that bad. The signal that this bond market is giving us that there's an emergency cut coming, that they're going to have to step in. Nela Richardson was just saying it. If the Fed is going to do that, what are we doing here? What sort of framework are they working with that just 4.3% in unemployment would mean an emergency cut? That surely would confuse many people.
This is an aggressive bull steepener. It's a continuation of what we saw in July. A 50 basis point move in July, 2-year yield lower. Just last week, 50 basis point move lower again on a 2-year yield. On a 2-year right now, aggressively lower compared to where we were only a few weeks ago. So how does that set us up in foreign exchange? It means a ripper of a rally in a Japanese yen. Dollar yen is down at 142.55, a massive move there. In Japanese equities, a 12.4% move on the Nikkei 225, the worst day of losses in Japan that we've seen going back to 1987. So will things settle down? What's the circuit breaker for this? A Fed speech a little bit later or some economic data? Let's talk about the week ahead. We've circled two things for you here. One is the ISM Services Index a little bit later this morning, 10 a.m. Eastern Time. The other is jobless claims on Thursday. If this sell-off, if these moves are all about the data between Thursday and Friday, ISM manufacturing, jobless claims and payrolls, can we settle things down, Danny, if you get a decent read on ISM Services? And what happens to this market if we don't?
I am scared for what happens if something is weaker. Again, just because so much of this feels to be a liquidity squeeze, I'm questioning how much of stronger data could really stop it. John, you'd have to hope it stops it somewhat. But again, if a lot of this is yen appreciation, hurting the tech trade, a more mechanical type sell-off, it's unlikely that strong data on its own can be the circuit breaker.
Look out for that data a little bit later this morning. Here's the lineup for you over the next hour. We'll catch up with Sarah Hunt of Alpine, Saxon Woods. As this market sell-off continues, we'll speak to Claudia Sahm of New Century Advisors on the Sahm rule. Look out for that conversation later this hour. And Ed Al-Hussainy of Columbia Threadneedles as traders ramp up bets on an emergency Fed rate cut, which I have to say a lot of guests this morning, so far this morning, pouring some freezing cold water over the prospect of that actually happening. Let's kick it off with our top story. Global stocks selling off on concerns that the Fed is behind the curve. Sarah Hunt of Alpine, Saxon Woods writing this. The totality of the data seems to have shifted. And that was a certainty last week. Sticking the soft landing now is being called into question. Sarah joins us now for more. Sarah, good morning to you.
Good morning.
What changed at 8:30 Eastern Time on Friday morning?
I think it started to change on Thursday, and Friday just confirmed the fact that the data was in fact getting weaker. Those ISM numbers were weak on the manufacturing side, and then you had a payrolls report that was much weaker than people expected. And there's been a lot of controversy on the payrolls report of how much of how easy is it to interpret the data and whether or not the birth-death model makes a lot of difference. And when the numbers were high, nobody worried. And now that the numbers are coming down, people are really starting to worry. And you start to hear that conversation again, like how strong was it really all year and how strong is employment? And I think that that's part of the problem that you're having. And it just reinforced the fact that you had weak ISM numbers.
Let's chop up the equity market. 7% move lower almost on small caps last week. Financials got battered on Friday. Tech's getting hammered this morning. Banks are down again. Is there anything about these moves that you want to pick up the pieces anywhere at all?
I think the place that most people are going to want to pick up the pieces is going to be technology, because I think you had a guest on earlier this morning that made the point that the small cap trade and the bank trade didn't make a lot of sense if you thought the economy was going to get weaker. So I would say that that also is true, and that was one of those what else can we buy trades, as opposed to we really need to be in these sectors right now. I think that some of what's happening in tech is just you haven't really had a correction in a long time. You had this market running right up from January to July, and then we did a complete U-turn. So I think that that's where people are going to want to be. To Dan Ives' point, I don't think it's the end of the world, but it certainly is a very fast correction and a very strong correction when people were not necessarily expecting this much drama. But you have so much that's happening on an unwind of the carry trade, to your point on the end. There's so many different mechanical pieces underneath that it's hard to parse them all out because they're not obvious. It's not one thing, like earnings were terrible. They weren't. They were okay. It's just a lot of different pieces.
But I wonder, even if tech is the trade, is some of that huge enthusiasm we had over AI, is that just done in a market where you need to worry about whether the Fed is going to cut or not? Can you really be so hopeful on giving those companies more time to let their AI plays play out?
Well, if you think about some of the parallels that people have made to like the 2000s, right? You had a lot of companies in the 2000s that were selling to customers that didn't have any money. So they were financing their own customers. It was a whole different situation than what's happening right now. I think that AI is like dark fiber back then. People are putting in capacity because they're not sure exactly how they're going to use it, but they're pretty sure they're going to find a use for it. Is that as fast as people expect it to be? Probably not. Is it what people expect it to be? It never is. It always changes. So I don't think that that goes away. And the companies that are bankrolling spending on this have a ton of money. It's not like they're in trouble in any way, shape, or form. But the timing was always going to be, Wall Street's so quick, immediate. I need to know immediately what's going to happen. And that's not the way it's playing out. And I think that that's part of what you're seeing here as well.
But even so, when you do see these stocks swing to the upside, the moves are huge. I mean, you get, again, $100 billion+ moves on the upside or on the downside for just a single name like NVIDIA. Does that make it harder just to stomach, to hold on to the ride?
It's one of the reasons why you're not supposed to look at your portfolio every day, right? But we do anyway, because that's what we do for a living. And I think the problem is just you had the law of large numbers with a lot of these tech companies. The earnings moved so fast for NVIDIA in particular because people were scooping up those chips and they were being able to charge higher prices for them. So then the question becomes, okay, when things settle down, what kind of pricing can they get? And AMD all of a sudden is now becoming a player, which people thought that they would be, but that didn't seem to be. And then all of a sudden their earnings were good and they were like, yes, look out for us. So there's a lot of moving parts. And yes, those things swing around a lot.
Let's just sit on the Fed just for a moment. Sure. We'll catch up with Ed Al-Hussainy a little bit later this hour. He draws the distinction between a Fed cutting to become less restrictive and a Fed cutting to become accommodative. And I'm trying to work out where we're going to be in September. Are we cutting to normalise, or are we cutting to address a growth shock? Because they're two very different things. And I just wonder how different your capital allocation decisions would be based on what kind of decision we actually get in September.
Well, that's part of the U-turn, right? And that's part of, if the Fed had cut last week, which I would argue that they should have at least 25 basis points, then I think the amplitude of this would have been lower. You still would have had a directional downtrend, but I don't know if the amplitude would have been so high. And I think part of the problem is that's what they were moving towards, which is cutting to normalize. And now the growth scare is making that shift to maybe they're cutting because they have to. And that's where the 50 basis points, I think, is a push, because I don't think that they want to look that that worried about it in September. But I think that if there really is a growth scare, I mean, we've been trying to position for slower growth anyway. So it's not like that's going to change our allocation too much. But in the end, this quick turn from markets and perception and investors from it's all fine and we still have growth to, oh my God, the world is coming to an end, is really made all of the markets come down. And I mean, everything is coming down right now. So I think that I don't think people were expecting the amplitude of that change.
OK, so I'll put it another way. Are these rate cuts worth buying or rate cuts I should sell?
Oh, that's a tough one, too, because, I mean, I think that the question about, I was thinking about this in the green room, the question about rate cuts and what happens with rates when people are piling into treasuries as a safety trade, it stops becoming about rates and it starts becoming about safety. So it almost doesn't matter in the near term because people are piling into treasuries because that's someplace to put money. And I don't know when that flips back to, no, we really care about what the Fed's doing, and that's why I'm buying bonds, to I need to buy bonds because they're safe.
You mentioned what would happen if we got a 50 basis point cut. Sarah, if the Fed does do what this market is saying, an intermeeting Fed cut, what would the reaction be?
I think, unfortunately, because they missed the opportunity last week, the reaction to a intermeeting cut would be, what are they seeing that we don't see? And I think that's what they don't want to do, right? That's what markets don't want to have, is that kind of, 2 weeks ago everything was fine, or a week ago everything was fine, and now you feel like you have to come and intervene, when 25 basis points, to be fair, is not a huge cut. It's just that people were worried that if they went 25, they would expect that they would keep going. And I don't, that kind of concern I don't really understand. I think the Fed has more power than that, but they seem to get trapped into perception, and I think that that's part of the issue.
I just want to make sure I walk away with the right impression of where you're at currently. Do you think the pendulum swung too far in the other direction now?
Absolutely. But I don't know, but it doesn't...
More so in stocks or in bonds?
Both right now, because the bond is a panic, where am I going to put my money? And the stocks are, oh my goodness, the world is coming to an end. But the question is, did the whole Olympic stick the landing thing, when does that knife stick? And does it keep falling? And I don't know, because things always move too far. And there have been a lot of really levered trades that are underneath all of this, the yen, everything else that are unwinding that we can't see. And that's where it's hard to figure out, where does that stop? I think that this is an overreaction, but I don't know when that overreaction stops, because I don't think that the underneath is as bad as it has been in the last couple of times the market's really had problems.
I'm just trying to work out where we actually really are at the moment. And we'd asked this question a few times over the last few weeks coming into that unemployment report. If we triggered the Sahm rule, and Claudia Sahm's going to have her own thoughts on her own rule a little bit later this morning, so you should look out for that. I said if we triggered it with this market behaviour as if we're in a recession already, even if the Fed policymakers and everyone else said we're not, would the market begin to behave like we're in a recession already? And this tees up, I think, the data a little bit later. Let's say we get ISM services and it comes in strong. Is that data that this market's going to ignore? Because it's so firmly fixated on the view that that's where we are now, a recession, and it embraces weakness and ignores strength. I'm just trying to work out how we respond to incoming information, how sensitive we are to strong data, how sensitive we are to weak data.
Well, I think this goes back to Danny's point. How much of this is underlying mechanical trading problems, and how much of this is a reaction to the data? It started as a reaction to data, and then it became its own problem. And that's, again, the problem of highly levered trades, is that when they go against you, the forced unwind is not necessarily things that people want to do, but it's things that people have to do. So the data can help slow that down, possibly, but it's not as much reactive to data as it is reactive to margin calls and to other issues that are underneath that on the financial side. So I think that the data would help, but bad data could make it worse. Good data might make it a little bit better, but I don't know how much that's going to stop this. This has to stop on its own, because there's some calming down of forced selling, and I feel like that's what we are right now.
And that's where we are right now. Forced buying of the Japanese yen as well, in particular. Sarah Hunt, thank you. Sarah Hunt of Alpine, Saxon Woods, dollar yen right now, 142.73. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Former President Jimmy Carter is holding out to vote in the November election. The New York Times reporting the oldest living president told his grandson, quote, "I'm trying to make it to vote for Kamala Harris." Carter, who turns 100 on October 1st, has been in hospice care in Georgia for over half a year. Early voting in the state begins on October 15th. Hurricane Debbie has made landfall in Florida as a Category 1 storm with winds topping 80 miles per hour. The storm is expected to push as much as 10 feet of water inland and bring heavy rain. The White House said President Joe Biden declared an emergency in Florida and ordered federal resources to help the state. And Goldman Sachs economists raising their odds for a U.S. recession in the next year from 15% to 25% after Friday's weak jobs report. Chief economist Jan Hatzius did note that the risk is limited and the Fed has room to act quickly if needed. He also thinks the economy continues to look fine overall. The team at Goldman predict the Fed will cut rates by a quarter point in September, November, and December. Meanwhile, JP Morgan and Citi are calling for the Fed to deliver a half-point cut in September. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the programme, big tech leading big losses.
The reality is tech is also rate sensitive. And in addition, if we do start to think that, if nothing else, the economy is going to be softer, some of the trades that people were running into in July, that doesn't make sense in an economy that's moderating.
Up next, Ed Yardeni of Yardeni Research, live from New York City this morning. Good morning. John Stolfus, Oppenheimer, is the quote from him. Last week's equity market downdraft on the back of the jobs data, in our view, likely provides opportunity for another rally. No change from the team at Oppenheimer. We'll come back to that note a little bit later. Your scores look like this. We're down 2.8%. Not on the month, not on the week, on the day, on the session. We're down by 2.8% this morning on equity futures. This one's an ugly one. In the bond market, the rally continues. We're down 5 basis points, 373.97. And speaking to the growth scare, crude lower by 1.7%, WTI 72.27. Under surveillance this morning, big tech leading big losses.
The reality is tech is also rate sensitive. And in addition, if we do start to think that, if nothing else, the economy is going to be softer, some of the trades that people were running into in July, that doesn't make sense in an economy that's moderating. If anything, you're probably going to be more inclined to look for a higher quality, revenue consistency, earnings consistency. Where do you find that? You find that in a lot of the mega cap tech names.
A lot of you looking to pick up the pieces. Some people taking the other side. That's what makes a market. Here's the latest. The global stock sell-off continues, ignited by weaker than expected economic data. Traders are waiting more data this week. We get the ISM Services Index coming up today at 10 a.m. Eastern Time. Ed Yardeni of Yardeni Research has this to say. A weak July employment report does not a recession make. The financial markets reacted on Friday as though it does. But we believe that report was a weather-impacted anomaly and not representative of the strength of the US labour market. Ed joins us now for more. Ed, thanks for jumping on with us early this morning to go through some of this. These are some big moves. Let's just start with your point. What about Friday tells you that that's the anomaly and not the start of a new trade?
Well, I think to a large extent, the Friday sell-off had more to do with the carry trade unwinding. The Japanese central bank and the finance ministry have indicated they want to see somewhat tighter monetary policies over there. And apparently, we never really appreciated the scale of these carry trades. It just happens that all these things kind of came together on Friday. I think the markets did have the Sahm rules scare that, you know, the unemployment rate's gone up a little bit, and the next thing it does is it goes up a lot. But history shows that really only happens when you get a credit crunch. Now, it's conceivable that this carry trade unwind becomes some sort of financial crisis that in turn leads to a recession, but that's not where my thinking's at. The other issue, of course, is geopolitical risk, and everybody's kind of nervous about the potential for a wider war in the Middle East.
Except crude selling off, which speaks to the overall concern, the overarching concern about growth in America. So, Ed, if that's your view on things, just go through things right now, in equities, in bonds. Do you think we've overdone it in equities, in stocks, in fixed income, in bonds, or both?
Well, I think we've overdone it, and I think a lot of it is the forced covering of these carry trades. It's hard to assess how much more we've got to go, but you know, these traders move awfully fast, and we're seeing that in this kind of vicious sell-off on a global basis. I think the fact that it's a global sell-off has more to do with the carry trade than a couple of numbers here in the U.S. suggesting the economy is weaker.
Well, you talked about one of the risks that you're not worried about at this moment, but the risk that the sell-off gets people to think that there's going to be a recession, act like there will be a recession, and a recession happens. At what point do you get worried about that risk?
Well, I'm worried about it now. I mean, clearly, when you see these kind of sell-offs, you wonder what you're missing. I mean, this is very reminiscent so far of 1987, when we had a crash in the stock market that basically all occurred in one day. And the implication was that we were in or about to fall into a recession, and that didn't happen at all. It had really more to do with the internals of the market. And I think that's the same thing going on here. I think a lot of this sell-off has to do with this carry trade unwind, and it's conceivable that it could feed on itself and create its the worst scenario where everybody hunkers down and says there must be a recession out there. But I don't think so. I think the labor market's still in good shape. I think the U.S. economy is still growing. I think the service economy is doing well. I guess we'll see very shortly here. But all in all, I think this will turn out to be more of a technical aberration in the market than something that turns into a recession.
And I hate to hammer on the bearish base case, because I know it is not yours. But if it is conceivable that something like that could happen, that kind of feedback loop could happen, is it then conceivable that the Fed does something like a 50 basis point cut or even an emergency cut?
Yeah, absolutely. I mean, this is turning into a global financial panic, and I think we can expect that the central banks will respond to it. And I think that their initial reaction will be to try to lower concerns about the U.S. economy and to push back against the idea that they're going to do 50 basis points. But, you know, another couple of days like Friday and this morning's future sell-off, and I think the central bank will be going into, the mode of providing liquidity. And that could very well mean a 50 basis point cut.
Do you think they are in a position to activate the so-called Fed put? I'm going to share this quote with you from Peter Chia of Academy. If the Fed does anything that looks or smells like they're eager to embrace the Fed put, we would likely see inflation starting with risk assets. They're caught between a rock and a hard place in terms of being able to be aggressive. How constrained do you think they are? I
don't think they're constrained at all. I mean, if they conclude that this global liquidity sell-off in the carry trade has the potential for causing pushing the U.S. economy into recession, they can move pretty quickly. I mean, they could even move before the next meeting. I don't think they want to do that because that would signal that they're getting panicky. But the markets certainly are panicky enough to have an impact on Fed thinking.
Yardeni of Yardeni Research, thank you, sir. Drawing a distinction between what he thinks is just an unwind of the carry trade versus, say, some fundamental growth shock triggered by the data we got last week.
Exactly. But as he was saying, there is this threat that it feeds back on itself, and it in itself causes a growth shock because you have people pricing an emergency cut. Therefore, the Fed does an emergency cut. Therefore, we panic, think there's going to be a recession, act like there's a recession, and then a recession happens. But I think the through line with everyone we've been speaking to this morning, John, is that is a threat, but that threat is kind of in the background now, that the data has been strong. And sure, there's a sell-off, in part mechanical, and it could get worse, but this isn't it. This isn't a recession right now.
Yeah, after Friday, I'd say this wasn't just a fear of going into recession. The market started to behave like we were in one already around this Sahm rule. And I can't wait to catch up with Claudia Sahm. Claudia Sahm of New Century Advisors on her Sahm rule is joining us in about 5 minutes' time. So don't miss this. We've got lots of commentary for you on the sell side. This from Ian Lingen of BMO. The shifting sands of economic sentiment will define trading in US rates during the week ahead. Price action in risk assets will cast the final vote on how far the bond bullishness is able to extend. And this market's casting its vote right now, and it's pretty negative. On the S&P 500, we are lower. On the Nasdaq, we are down. On the Russell, we are aggressively lower. On the S&P, we're down by 2.8% on the S&P 500. From New York City, good morning to you all. So there's plenty of bearishness out there. Here's the more constructive view on this equity market from John Stolfus of Oppenheimer. We know that with Fed funds at 525 to 550, monetary policy officials have ample dry powder to manage the landing. He thinks there's an opportunity here to buy this market, and this market's still selling off. We're down by 3% on the S&P 500, negative by 4.5% on the Nasdaq. We're off by 4.5% on a Russell 2000. The small caps all over the place. Danny Berger alongside me throughout the morning. Danny, we were down almost 7% on the Russell just last week, and we add to those losses on the session so far.
With all of these moves, and small caps maybe the most of which, it's so painful because you just had so many people come out and say now is the time to buy small caps, that this rally can sustain itself. Even with the broader market, you had people coming out calling for 6,000 on the S&P 500, people calling for even more when you look out into the future. That all literally just happened. And I know hindsight is 20/20, but you could look at that and say, maybe that was something like the top.
Some of those people are still calling.
Sure, absolutely.
For some of those numbers, and that has not changed since Friday for those individuals, and Stolfus is one of them. I want to turn to the bond market. Coming on to Monday, through the weekend, through Friday, we were on a 4-day winning streak on a 2-year, a 7-day winning streak on the 10-year. And you can add to that. Make it day 5 on 2s, day 8 on 10s. The 2-year down 15 basis points to 373.36. Danny identified this earlier in the session. I think we should sit on it just for a moment. Look at the difference between a 2-year and a 10-year. Danny, we're down to a single basis point.
Exactly. We are so close to this thing uninverting. And again, that's when many people have said it's not the inversion that matters for the recession. It's the uninversion. But you got to bring it back to Jay Powell himself, talking about the Sahm rule and the inverted yield curve, saying that it's different this time. They are just statistical normalities. They don't actually tell you anything at this moment. And again, it goes back to the panic of this market, even the panic of some people in Powell's press conference being very dovish, and Powell and Goolsbee on Friday being extremely calm. This is not a market that is calm.
The P word is not a word we use lightly or loosely on this program. But if you look at Japan, I think we can use it. This is what panic looks like. A 12.4% move on the Nikkei 225. Think about everything that's happened between now and 1987. And yet this was the biggest move since 1987 on the Japanese benchmark.
Yeah, on what? The BOJ hiking? I mean, you have to scratch your head and say, fundamentally, this is an odd move. But it gets less odd when you think about all of the people. Again, this goes back to the small cap thing, of all the people who piled in to Japanese equities, of all of the people who are just glomming on to this carry trade. And then what happens when it unwinds? This is the kind of thing that, again, it might not be fundamental, but it certainly has a mechanical feel to it.
Dollar yen is down for 5 days. Over that period, we've had a move of 7.4% in the yen's favour. That's a massive rally on a single currency. And as Danny and others have pointed out, there's a lot of trades that build on top of that short Japanese yen trade that developed over the best part of the last 2 years or so. That's the FX market and what's been happening in Japan. Under surveillance this morning, the global stock sell-off, ignited by weak payrolls data, continues today. Big tech leading the drop. Check out these names: Apple, Nvidia in the pre-market, lower and lower aggressively. Nvidia down by 11% in the pre-market. And you've got to wait until the end of August to get earnings from this player.
And that's why, again, Russ Koesterich started us off with this, that I think was really the tone of, sure, these are names you want to buy, and a lot of people have been waiting for the sell-off in order to buy them. But can you really jump in with both hands this morning? And perhaps you can't, because the losses could get worse. But again, it goes back to the Dan Ives of the world saying there's still value here. I still want to be long these stocks, but it doesn't mean that there won't be more pain in the short term.
Looks like a growth shock, feels like a growth shock. Sounds like a growth shock. Check out the commodity market just to confirm that. You've got all this tension in the Middle East, all this tension, and yet crude is lower on the session on both WTI and on Brent. As we're all sitting here waiting to see how Iran retaliates against Israel in the Middle East, this is what's happening with crude. We're pulling lower by 1.8% on WTI, on Brent crude down by 1.6%.
And it will be a vicious move if something does happen, because it's hard to make the argument that you should be selling oil if there is more geopolitical angst, if there is something that does look like escalation, because that had been the big fear of this market, of Iran retaliates in a way that isn't just like July 13th, where essentially you can just block all of the missiles coming in and it's no big deal and you carry on as they were before. If that does happen and you get more volatility in oil, again, it's just another asset class that will be swinging from huge gains to huge losses. Does that just feed into the market volatility all over again?
That's the Middle East and the commodity market. Let's just pause. Let's take a beat. Let's park all the price action and just sit on this. I know many of you have heard this phrase in the last few weeks. In fact, for the last few months, we've been talking about the so-called Sahm rule. The rise in the unemployment rate in July triggering the Sahm rule, a recession indicator for so many, which has a perfect track record over the past half-century. Claudia Sahm herself, of New Century Advisors, saying this: I don't look at this and big picture say we are in recession, but I look at this and I say we're not headed in a good direction. Claudia joins us now for more. Claudia, you're famous if you weren't already. I think you know that anyway. It's great to catch up with you. I just want to take a beat and just sit on this for a moment. Claudia, let's go from the very beginning. Tell us what the Sahm rule is, what you wanted it to be used for, and whether you think it's applicable in a labour market like this one.
So the origin of the recession indicator was in a proposal I had to improve fiscal policy, put it on autopilot, automatic stabilizers in a recession. It's a rule in the sense of not the economy must do something. It was a rule in the sense of policymakers do something. It may end up playing out that way. So, but what the idea of it was to look at the historical record in the United States and find the pattern, find the unemployment rate increase. It's very important to look at changes at which, in the past, the U.S. has been in a recession, months into a recession. This is not a forecast, right? And so it's just trying to capture, and yet it is absolutely true that it doesn't have to be that way this time. And frankly, if we look at all of what we know about the U.S. economy, right now, it is very unlikely that we are in a recession. And yet a really important question is, where are we headed? And those changes in the unemployment rate that the Sahm rule picks up on, they do not look encouraging, right? They're headed in the wrong direction. And that momentum is what can get us in trouble.
So, Claudia, for just all of those people out there who are talking about your name, who are talking about the Sahm rule, using as an excuse to sell, using as an excuse to say that the Fed should be moving sooner. Just what do you say to those people?
Calm is important in a moment like this, regardless of what indicator or data point you're looking at. You know, the fear does no good. And this, again, this was trying to give a simple summary of one piece of the U.S. economy. The labor market is very important. There's a lot of complications right now. Again, it's this balance between be calm, but take it seriously. Right? Like, there is slowing in the U.S. economy, and we have seen that. The point is to keep that slowing from really pulling us in reverse. We're not there yet. Usually the Sahm rule, by the time it triggers, we're past that point, right? So there is this opportunity of, as I said, the Federal Reserve has a lot of place to ease. We do come into this in a position of strength, broadly speaking, in the economy. So that's really important for weathering a storm like this that has many different contributors to it today.
I didn't mean to use your pun as a segue, but I want to in terms of storm and weathering it, because on Friday there was just this huge debate when the numbers dropped of people saying, look, don't believe the numbers you're going to see because they will revert quickly, because a lot of it has to do with weather. A lot of it has to do with Hurricane Beryl. But by the way, the BLS comes out and says there's no discernible impact. Which side of this do you fall on, Claudia? Whether the numbers we saw on Friday are something that can somewhat reverse because it's a weather impact?
It's absolutely the case that any indicator, and the Sahm rule fits into this, should not be designed to overreact to 1 month of data, right? So the Sahm rule it smooths across months. The pattern it's responding to is a gradual steady increase in unemployment over the past year. Okay, so there's that. In terms of weather effects, the Bureau of Labor Statistics has the ability and the experience to look very carefully at the geographic data to get a sense of where its effects are. I think they take those statements very seriously, and I agree with them for a lot of reasons, including their statement, that the unemployment rate, specifically the Sahm rules on, was not affected. The labor force status was not affected. Being home being unable to work because of the weather doesn't flip you out of being employed to unemployed. So it gets really technical in that, but absolutely, that 1 month, that was a big surprise. It was a -1. A prior of just some of that will reverse is probably the right one. But it is the context of the year as a whole. And even moderate slowing and this increase in the unemployment rate has been in the past consistent with early in recession. So we might not be there, but we're getting uncomfortably close to that situation.
Claudia, you've worked at the Federal Reserve. You know better than most how that institution operates, how slowly it can move sometimes. How do you think it's going to respond to this data? Not just on Friday, but the data from Thursday as well, as we go into Jackson Hole.
On a day like today, when, as you said, the panic word is looming large for many people, the fact that the Federal Reserve is slow moving and deliberate, it's a good thing, right? The last thing we need is them joining into that that kind of that energy, that emotional energy, and yet they're watching it very carefully. The market functioning, liquidity, these are all the reason that we have the Fed is to make sure the markets keep functioning. Monetary policy then came later, right? So there is this aspect of them being diligent in terms of them looking at Friday's report and changing dramatically their views on a September rate change. I think that would be unlike them, and I think it would be premature, right? They're pointed in the right direction. They have some time to get there. But yes, they are slow moving, particularly when it comes to the economic data.
How do you imagine they'll frame that first interest rate cut? Do you think that's going to be framed as a mid-cycle adjustment, the process towards sort of normalization, or the first step towards taking a more accommodative stance, given what's developing? How do you think they're going to frame it, just given what we know so far?
Goodness, September feels like a lifetime away right now. I think if they can. The Fed likes to move in on the path it set out. The path it has set out is to begin normalizing interest rates because inflation is normalized and we are in, kind of everything is pointed in that right direction. I think they're going to want to keep to that narrative and to that path if they can. The last few days have called into question whether that is appropriate, will be appropriate at that point. And I will say one thing for the Fed, it is very deliberate. It can be very slow moving, but when the facts change and it gets its mind around it, it will move and it will do what it has to do. And we are in a position right now where they have the ability to do quite a bit, and that is notable.
And John made the point that both Citi and JP Morgan have changed their call now to see 2 consecutive 50 basis points cuts from the Fed. Claudia, what difference does it actually make, moving 25 or 50 in September?
It all fits within the context of that moment, right? If for someone changing to 50-point cuts, particularly consecutive ones, that's a pretty dire outlook for the economy when we get to that point, or in the intervening. That's not where my baseline is. I don't think that's where the Fed's is. I mean, looking at the data and where we're at, and yet, clearly, if we were seeing large moves like that out of the gate, there's a real problem. But we saw some big moves out of the gate in fighting inflation in 2022 in the other direction, and the Fed will take its policy to where it needs to be to the conditions in the economy.
Claudia, we appreciate your time. Just fantastic to speak to you personally. Claudia Sahm there of New Century Advisors with the rule, the Sahm rule. And that Sahm rule has been butchered by a number of people over the last few months, but sort of setting the record straight there on where she thinks we are at the moment.
Yeah, I gotta wonder how annoyed she is that everyone's using her name as a pun these days. It's like somebody once told, like so many Sahm puns out there. I gotta feel for her for that. But talking about this idea that moving 50 basis points consecutively would mean something bad happens, does the Fed really want to do that? Because the data, again, to Claudia's point, it's not trending in the right direction, but it's not horrible. Does that signal the Fed knows something that we don't?
The difference between 25 and 50 is signal, and it goes to exactly what you just said. I want to keep going back to the central question we've been asking on this programme now for months. Are we witnessing a welcome cooling or an unwelcome deterioration? Is this normalisation or something more nefarious? And quite clearly, this market's casting a vote on what it thinks it is, what the answer to that question is, after Friday.
And does the answer to that question not even matter if the market is voting in this way? Is this a Fed that will have to respond as if things are deteriorating if the market runs away from it and it has issues like the wealth effect, meaning people really pull back and maybe business decisions aren't being made because of the equity market damage?
Yeah, this is that old adage that, markets can shape the events they anticipate, that George Soros stuff.
Right.
Like we've talked about this a million times. It's that one of these moments. If this continues, sure. It's a show me moment. Show me the economy's not as bad as this market thinks it is. And that starts at 10 a.m. Eastern a little bit later. The problem I've got with that argument at the moment is that the calendar for the data is actually really light now through the next week or so. Hardly got any Fed speak. 2 big data points for me. ISM at 10, jobless claims on Thursday.
And we also said that it was a show me moment for tech earnings. And they showed us, kind of, and it didn't do enough. And then if you want to wait for tech to do that again, you have to wait a while for NVIDIA. So in the meantime, our imagination can just run away with itself with investors who are impatient on AI really showing up, investors who are very long AI, and it's just an easy place to sell when there's a liquidity crunch.
NVIDIA earnings at the end of this month. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Heckes. Hey, Yahara.
Hi, John. Vice President Kamala Harris is getting ready to announce a decision on her running mate. According to people familiar with her plans, the vice president met with at least 3 possible running mates yesterday. Arizona Senator Mark Kelly, Pennsylvania Governor Josh Shapiro, and Minnesota Governor Tim Walz. Other possible choices include Kentucky Governor Andy Beshear, Transportation Secretary Pete Buttigieg, and Illinois Governor J.B. Pritzker. Harris plans to kick off a tour of 7 battleground states tomorrow in Philadelphia, and her running mate is expected to join her. U.S. candy giant Mars is considering buying snack maker Kellanova in what could be one of the biggest deals in the consumer industry this year. That's according to Bloomberg sources. Kellanova spun off from Kellogg last year as part of a restructuring and includes brands like Pringles, Cheez-It, and Pop-Tarts. The deal would link those brands with Mars staples like Snickers, M&Ms, and Skittles. Kellanova shares have gained over 12% this year, with the company valued at over $21 billion. And it's day 10 of the Paris 2024 Summer Olympics. Today's events include finals in the triathlon, gymnastics, surfing, and track and field. Team USA is in the lead with 72 medals, while China is second with 50, and host nation France has 44. As far as the most gold medals, China is now in the lead with 21, and the U.S. at 19. That's your Bloomberg Brief. John?
Yahara, thank you. Yahara is going to be back in about 30 minutes' time. Up next on the programme, it's the path, not the destination.
Our number one highest conviction trade for 2024 coming into the year was volatility. That means, and we're seeing it, and that means the path is more important than the destination.
We're getting a lot of volatility right now. That conversation up next. From New York, you're watching Bloomberg Surveillance. Equity futures negative here. Near session lows, actually. We're down by 3.2% on the S&P 500. The rally in bonds continues, down 7 basis points on a 10-year, 371. We're down 15 on a 2-year, 373. And as Danny said a few times already this morning, the distance between a 2-year and a 10-year now just a single basis point. That bull steepener continues. Under surveillance this morning, it's the path, not the destination.
The level in 10 years that we see at the pivot point is 385. So any yield below 385, we are better sellers, with underweight duration. Above 385, we start going long duration. It is our full expectation that we'll test both ends of that. That underscores one thing. Our number one highest conviction trade for 2024 coming into the year was volatility. That means, and we're seeing it, and that means the path is more important than the destination.
We're definitely seeing it. Here's the latest. Treasuries surging, with bond traders around the globe piling into bets that the Fed will start cutting interest rates. We're down another 14 basis points at the front end of the curve. Al-Hussainy of Columbia Threadneedle writing this: there is an uncomfortably high probability that we have entered a recession in the United States. With non-trivial odds, the Fed will have to act faster, including ahead of the September meeting. Stay long duration. Ed joins us now for more. Ed, let's get into timing first, and then I want to talk about the nature of the rate-cutting cycle you're anticipating. Do you actually believe that there's justification here to move before September 18th?
Yeah, look, I think particularly if financial conditions start to tighten or continue to tighten at the pace that we're seeing at the moment, the answer is going to be yes.
How much more tightening would you expect, and where would you need to see it? Is it another 5 to 10% in equities? Is it 100 basis points widening in high yield? What would constitute sufficient tightening of financial conditions that the Fed would have to come out and say, it's time to go, we can't wait around?
Yeah, I mean, it's really a difficult judgment call. Intervening cuts are very rare. Let me put it that way. So that cannot be the base case right now. But if financial conditions deteriorate, particularly in the form of liquidity in credit, that's something I've my eyeballs on. Liquidity in credit, liquidity in treasuries. We saw a very violent move on Friday. If we see a couple more sessions like that, then Fed participation in markets, I think, becomes quite important.
But it hasn't been credit leading the risk off. It's been equities, it's been bonds being bid. Does that give you any comfort? Because past times we've seen this market action, it's been credit that screams for some while until the rest of the market realizes.
Yeah, look, I think the credit picture this entire year has been very positive. It's been a very low volatility part of the market. It has not responded to some of the ups and downs and inflation that we saw in the first quarter of this year. It really reflects the fact that underlying fundamentals on the corporate credit side are really good. But at this stage, we've priced in a very good story for credit going forward. And we're at a point where we could see that get infected from what we're seeing on the rates on the Treasury side.
So if that does happen and the Fed is forced to move because you do have that undue tightening in financial markets, Ed, how convinced are you that this stops some of the unwind that we've seen? And it's not something that causes further panic, because we ask, what does the Fed know that we don't?
Yeah, it's a really difficult balance, because ultimately the mandate for the Fed is to reduce the risks to the real economy, right? Acting a little bit faster, I think, buys them insurance that the deterioration of the labor market that they're currently seeing isn't going to become more widespread, isn't going to accelerate into the end of the year and into next year. That's going to be the primary mission. The volatility in credit and equity markets is in many ways secondary to that. And from that perspective, I think the case for acting, whether it's an intermediate cut or just a more accelerated easing cycle than they've been signaling all year, the case for that, I think, is quite strong.
Ed, I was reading your notes, and I think you focused on something really important that I'd love to develop with you right here in this conversation: the difference between becoming less restrictive and becoming accommodative. How important do you think that discussion needs to be? How central should that conversation be going into that September meeting?
I mean, I think it's critical. It's part of the conversation they're going to have at Jackson Hole at the end of this month. That meeting is going to focus, or that conference is going to focus on the efficacy of the monetary policy transmission. From my perspective, monetary policy has been quite effective, and the risks are, at the moment, is that it's been too effective, given the slowdown in the labor market that we're seeing unfold right now. And the conversation around taking monetary policy into more accommodative territory has to start this year, in my mind.
Ed, forgive me for asking for a number again, but what kind of levels are you thinking about in terms of interest rates this year? What would that be, down in the low threes to become accommodative?
I think we have to put Fed funds on a trajectory to about 3.5. That to me is a really nice rough bogey. At the moment, markets are pricing the Fed funds to come in about 100 basis points below the dots for both 24 and 25 in terms of what the Fed's forecast made in June. I think that's appropriate. The risks, in my mind, are skewed towards the Fed having to do a little bit more and front load that cycle to stabilize the outlook. So the more insurance you take out by front loading that easing cycle, the more room you have, I think, to take stock of the data at some point next year.
Interesting. Ed, enjoyed this. Thank you, sir. Ed Al-Hussainy there of Columbia Threadneedle on the need to get accommodative at this Federal Reserve and get accommodative quickly. And we're going to have different opinions out there, but that's certainly in line with the direction of travel in this market over the last few days.
It definitely is. But if you look at other central banks who were accommodative quickly, it didn't help them today. The ECB cut in advance, the BOE cut last week, and still you see bond market rallies there. Still you see a market that's pushing them to cut even more. Still their equity markets are falling. So on a day like today, is having a more accommodative Fed enough?
Brutal morning, brutal session so far. Let's see if it changes. We just took out the low on equity futures on the S&P 500. For the session, we're down by 3.4% on the S&P 500. The rally in bonds continues at the front end of the curve on a 2-year. We're dropping by about 15 basis points. The yield there at about 373. On a 10-year, we're down about 7 or 8 basis points to about 371, 372 on 10. Some big moves, wild moves, in fact, in foreign exchange. Dollar yen at the moment lower again for a 5th consecutive session on dollar yen. We're down 2.6% to about 142. Coming up in the next hour, the third hour of Bloomberg Surveillance coming right up with Lindsay Rosner of Goldman Sachs Asset Management, Dan Ives of Wedbush, Andrew Hollenhorst of Citi looking for a 50 basis point cut in September. And he'll catch up with Stanley of Santander. All of that still to come. Up next.
generative AI is one of these themes that has durability.
What have we heard this earnings season is that CapEx continues to go higher. We want to be positioned in those enablers.
Is there overinvestment in any sector? Not really. Corporate balance sheets look healthy. So, which is why I think we're still in a soft landing.
We would consider kind of fading the rotation and continuing to emphasize higher quality stocks.
I don't necessarily see this huge and strong rally between here and year end.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now. Your opening bell is 90 minutes away. Live from New York City this morning. Good morning, good morning. Here's your price action. Session lows on the S&P 500. We're down across the board. Here's the board. On the S&P, down by more than 3%. On the Nasdaq, down by almost 5%. On a Russell, down by 4.4%. We've talked about some single names. We've picked out big tech, some of the big players on Wall Street. Let's go to the tech names again. Look at Nvidia, down by almost 13%. On Apple, down by almost 8 percentage points. And check out the rally in the bond market because it continues. The two-year yield dropped last week by 50 basis points. We're down another 15 in today's session, 372.75. I've said a number of times this morning we need to take a giant step back. Just think about where we've been and talk about where we are now. Where we've been. I used this quote a little bit earlier this morning from Chairman Powell. Sintra, Portugal, July 2nd. It reads as follows. Because the US economy is strong and the labour market is strong, we have the ability to take our time and get this right. Have they run out of time? Have things changed that much in a single month? There's a payrolls report that shows 114,000 payrolls and an unemployment rate of 4.3% changed the game that much. The market seems to think so. We're going to get into that this hour. I want to talk about the week ahead and how much things could change again potentially and go to two data points for you. The ISM a little bit later this morning at 10 a.m. Eastern time. Then later on in the week, jobless claims. And Danny, there's a reason we keep going back to ISM services because much of this started on Thursday with jobless claims and ISM manufacturing spooking this market. This market was already spooked. Was even more spooked on Friday morning. Where are we going to be a little bit later this morning?
Well, part of it is a market that's run away with itself, that maybe it started with the economic weakness and the data coming in, but now it's transformed into something else. It's transformed into all these longs and short in the case of the yen that are getting unwound, and so the economic data won't make a difference. We're talking to Sarah Hunt of Alpine Saxon Wood earlier, who said that it would help, but it's not going to stop things. It won't act as a circuit breaker, and I think the question needs to keep being asked this morning, what can act as a circuit breaker? Is it the Fed doing emergency cut? Is it just these trades running out of steam? Nothing really seems so apparent at this moment of what stops it.
Let's talk about some of these trades. Japan is blaming the United States. We've got traders in the US blaming Japan. There's this feedback loop going on right now between dollar yen and what's developing in Japanese equities. Just to bring up the board again, if we can. The Nikkei 225, if you've missed this, I don't know where you've been, but if you've missed this, I'll show you what happened overnight. The close on the Nikkei 225, negative 12.4%. Now, if you'd asked me on Friday, have we exhausted this move? Going into payrolls, I think, pretty extended. We've unwound a lot of it. Then you've got another 2.8% percentage point move on dollar yen on the session so far. These moves continue, and they're equally as vicious this morning as they were last week.
Yeah, if you were wondering what it was like to trade in 1987, if you weren't before, you're getting a taste of it this morning. That's how bad the sell-off has been. But again, it gets back to this point of feedback loops. Are we in this position where you get strengthening of the yen, so you get risk off, and therefore you get people going into bonds that shrinks the differential between the U.S. and Japan, which then again just appreciates the yen, and it goes back and back around on itself. That's what makes this so hard to step out in front of. Even if you have a fundamental view that tech is a good buy, that we're not going into a recession, and the yen shouldn't be appreciating as much as it is, it's hard to make the case that now is the time to put on that trade.
This feels like a freight train over the last week or so, and it's a freight train, as Danny suggests, a lot of people don't want to step in front of. Coming up this hour, the lineup looks like this. We'll catch up with Lindsay Rosner of Goldman Sachs Asset Management. Traders raise bets on an emergency Fed rate cut, which I have to say, a lot of people on this programme this morning have poured some freezing cold water over. Dan Ives of Wedbush will be joining us, looking at some of these moves in big tech and why he thinks there's a buying opportunity here. And Andrew Hollenhorst of Citi expecting the Fed to start cutting interest rates by 50 basis points in September. We begin with the big issue. Global stocks selling off as investors boost the odds of an emergency Fed rate cut. Lindsay Rosner of Goldman Sachs Asset Management with this to say. The market has swung too far to fearing a growth shock and a hard landing. One payroll report and higher tick up in the unemployment report does not mean that the Fed no longer has the will or ability to help via the monetary policy channel. We are starting to dip our toe into adding risk. Lindsay joins us now for more. Lindsay, we can take a breath here. I've said a few times this morning, it feels breathless in financial markets, and I think you're the perfect guest just to sort of work through this methodically and with purpose. Let's start with the data on Friday, then we'll get to the market call. Why are you so unconvinced by the growth scare that developed off the back of the data last week?
So I think what's important is we're not scared or unconvinced with what we saw on Friday. What we do think, though, is it is a data point. It's certainly showing labor market weakness or softness, but we've been in a trend of normalization, and you are going to have soft prints along the way. That is okay for the market. The fact that we have the VIX this morning at 50 on 114,000 payroll number on Friday and an unemployment rate that's at 4.3%, which isn't terribly shocking in itself or a scary number, really still feels like an overreaction. Obviously, the market's reacting to the Sahm rule being triggered and nervousness of what's happening in global markets, but it does feel to us to be a bit overdone. And again, Friday was one print, and we want to see more data to get a bigger picture. And most importantly, the Fed has the ability to cut. They have a significant amount of room if they are to cut. And so we are actually in a good place from a monetary policy perspective with room to run.
Let's turn to the market call. Starting to dip our toe into adding risk. Lindsay, just breathe some life into that call. What does that mean? Where would you like to add risk this morning?
Sure. So for us, as we spoke the last time I was on the show, we've been very low in terms of the spread risk we've carried in our active portfolios. And that's because spread valuations have been at the tightest levels of the past 10 to 15 years. We have been waiting for an opportunity for spreads to widen because we felt that prices or where assets were priced wasn't justified for us to have more risk on. Now that we've widened out a bit, we think it's time to start. We want to lean into high quality from the beginning. So whether that's investment grade, particularly I think it's in the US as opposed to Europe. And the other thing that we find interesting to watch but haven't found the right level yet would be high yield. In particular, the area of high yield that we have liked this year has been double Bs and single Bs. That has been the area that actually was close to unchanged on Friday. So we haven't seen move there yet. Today is obviously a different story, but it isn't about adding triple Cs. It's staying up in quality, whether that be investment grade or top of high yield.
Lindsay, I got to imagine there are a lot of people in your shoes who've said, I want to buy things like NVIDIA, I want to buy things like credit, but at these prices, it doesn't make sense. And all of a sudden, you get a window like today where the prices start to come back down to reality. But for a lot of those people, it's going to be frightening to jump in on a day like today where it's so negative. What do you make of sort of the timing of doing that? Do you want to jump in as soon as it starts to get bad, or do you need to see it play out more?
Well, I think it goes back to the principle of dollar cost averaging, right? That's the smartest way to play markets, whether it be equities or bonds. So it's not put all the chips in at this point in time because we're seeing 2 days of volatility. But it's starting, as I said before, to dip our toe. So we want to leg into opportunities as the prices make sense and spreads widen. Again, what's really important to us is taking a breather, as Jonathan suggested, looking at the big picture. And what are we actually seeing in the market? We're seeing corporations that are fundamentally in a strong spot. Balance sheets are still fine. We have no cliff of maturities. We are not seeing a default cycle pick up. We don't think a pronounced one is forthcoming. From an equity perspective, maybe a little bit overbought. We've now backed off from there. So the market is getting into a healthier zone, and markets don't move, even though I think we've been pretty used to it recently, in a straight line up. We have to understand that these kind of drawdowns and retracements happen. And this is why, from an active management seat where we are, we want to have the steady hands in the market to add where it makes sense.
One of the things, though, that we also had gotten used to, Lindsay, was just the huge growth numbers that some of these stocks were putting up. The Mag 7, NVIDIA, growing something like over 200% in a quarter when it comes to their earnings. I just got to wonder, given what we've seen so far from these hyperscalers, is it fair to say that that's also over and that's part of the reason you see what you see today?
Well, let me give the caveat first that I am a bond girl, not an equity girl, but I'm happy to answer the question. So on the equity front, I mean, we all know, you can call it what you want. Is it AI euphoria or true excitement about what could potentially be a new industrial revolution? Now I think we're getting to the point that we've got to shift from excitement and just speaking about what's going on to seeing the data, seeing the output from companies. And I think that's some of the softness and the retracement that we're seeing in equities right now. We're in the stage of CapEx, right? So there has to be investment to be able to do all of this AI. As we have that investment, that can be a drag. And so the idea that we snap our fingers and AI works and every use case is happening in the here and now, that's just not how a new technology like this will work. And so I think the market has to have some patience. And again, the jitters around whether the Fed goes or whether AI is working today, I think we all need to calm down a bit and understand that this is a process and this is very natural for markets, whether that be new creative technologies or how we move from different parts of the economic cycle.
Lindsay, I just want to pick up on that word, process, and think about that September 18th Fed decision. Bit of a conversation around the table this morning about whether this Federal Reserve needs to get accommodative or just less restrictive. And as you know better than most, there is an important distinction between those two things. What are you expecting now? Alongside the team, what are you looking for in September and beyond?
Sure. So let me answer first. We're not expecting an emergency cut. The market right now, while maybe it doesn't feel great today, is not in emergency mode, and therefore it does not necessitate a Fed acting from an emergency perspective. September is not very far away, although we all are enjoying our summer. September is coming, and they will have the opportunity to do what they see fit. We think there's a decent likelihood for them to go 50. If you remember, obviously, on the way up in rates, we had a host of 75s and 50s. It's not strange to think that they could go more than 25. And I think as the data, and we will get 3 more important data prints between now and September 18th, let's see how they unfold. And the data will dictate whether or not the Fed goes 50 or 25. But in our mind, as we've been saying all year, they will be going in September. I think there is more of a decent probability now that they do, in fact, go 50 to kind of get us in the right motion and get things started. And really, for us, that's the volatility we're seeing here. There's a baton being handed off. We're, to use a Olympic analogy, the baton was with the Fed thinking about, did they have enough confidence for understanding inflation was moving in the right direction? Now the baton has been handed to market participants who are trying to figure out, is the Fed going to react? And how significantly are they going to react? And in that kind of transfer of the baton, as it is in real life, it can be dropped. It can be shaky, and I think that's what we're seeing right now in the VIX and the move in spreads, and obviously the flight to quality rally as we're seeing in rates as well.
Cool, calm and collected. This was perfect. Lindsay, it's good to catch up with you as always. Lindsay Rosner there of Goldman Sachs Asset Management. I want to keep going back to the calendar. To Lindsay's point about that baton being handed off and the focus now being on the labour market, much more so than inflation, given the recent print we've just had. The calendar looks like this. So August 14th, about a week away, CPI report. September 6th, another jobs report. September 11th, another CPI report. September 18th, the Federal Reserve decision. Now, as Lindsay says, it's just around the corner, but at the moment, looking at this price action, it does feel like a lifetime away.
Yeah, and if you have Fed officials coming out and still being calm, as they had. I mean, Goolsbee was talking to Mike McKee on Friday and was very calm.
Did not hear panic at all.
No, saying that this was one print, and we do not react to one print. But if it is in the market's hands, how much will it matter if we get more Fed speak out saying we are calm, this isn't the sky falling, things are okay? If the market is running away with this narrative, they might kind of need to change in order to calm the market. They might need to say, hey, look, we are ready to act because the market is doing what it is now.
Equity futures down by 3.7% on the S&P 500, a 2-year. This rally at the front end of the curve is picking up. The yield move we're now seeing is lower by 16 basis points on a 2-year. 372. What a move. What a move at the front end of this yield curve. Let's take an opportunity to get you up to speed on stories elsewhere with your Bloomberg brief. Here's Yahara Hakez. Hey, Yahara.
Hi, John. Israel is bracing for possible attacks from Iran and regional militias following the assassinations of Hamas and Hezbollah leaders last week. Prime Minister Benjamin Netanyahu saying over the weekend his country is in a, quote, multi-front war against Iran's axis of evil. Amid the escalating tensions, the U.S. is moving a fighter jet squadron to the region and keeping an aircraft carrier nearby to help Israel. Still, the White House is urging Netanyahu to redouble ceasefire negotiations with Hamas. Vice President Kamala Harris is expected to announce her running mate very soon. According to people familiar, the vice president met with at least 3 possible running mates yesterday: Arizona Senator Mark Kelly, Pennsylvania Governor Josh Shapiro, and Minnesota Governor Tim Walz. Other possible choices include Kentucky Governor Andy Beshear, Transportation Secretary Pete Buttigieg, and Illinois Governor J.B. Pritzker. Harris plans to kick off a tour of 7 battleground states tomorrow in Philadelphia, and her running mate is expected to join her. And Hurricane Debby made landfall in the Big Bend region of Florida earlier this morning as a Category 1 storm. The National Hurricane Center said heavy rain and powerful winds could create storm surges topping 10 feet in areas north of Tampa Bay and into the Panhandle. Coastal Georgia and South Carolina could see as much as 30 inches of rain beginning Tuesday as the storm slows and moves east over Florida. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next on the programme, we'll get you some morning calls, check out the price action and catch up with this guy right here, Dan Ives of Wedbush, on the tech sell-off and why he thinks, as you might have guessed, this is a big opportunity. That conversation is up next, live from New York. Good morning. This just in this morning, Mike Wilson, Morgan Stanley. The bottom line is that the consumer has been weakening this year. The risk-reward for equities broadly remains unfavourable at this stage. He goes on to say it's hard to argue that many stocks are cheap if earnings revisions don't turn around in a definitive manner. The latest call from Morgan Stanley this morning. Let's turn to the price action. It's not pretty. We're down by almost 4% on the S&P 500. The move in bonds continues. Yields are lower by 9 basis points on a 10-year to 369.50 on a 2-year. Check out this, Danny. The 2-year's now down by 18 basis points. 370 on 2s.
And it means we're just about a basis point away from the yield curve uninverting. And look, on a day like today, when you get this liquidity squeeze, it's really hard to grasp onto reality of what actually makes sense in this market. Does it make sense to price in an emergency cut? But again, just because the price moves are unreasonable doesn't mean that they can't become reasonable because of a feedback loop that could emerge.
Everyone's got an opinion right now, of course, and there are many, but this just feels like it's taken on a life of its own this morning. Let's see if it changes later on when we get that ISM print at 10 a.m. Eastern Time. Let's get you some morning calls. First up, Morgan Stanley lowering its price target on Disney to 110 from 130 and keeping an overweight rating. The firm taking a more cautious view of Disney's parks business in fiscal year 25. That stock is lower by 3.6%. Next up, JP Morgan lowering its price target on Target to 153 from 165, keeping a neutral rating on the shares. The analyst saying the boiling of the frog consumer backdrop continues. The water's heating up. Doesn't sound good. Stock's down 2%. And finally, Bank of America maintaining a buy rating on shares of Nvidia and keeping the company as its top sector pick ahead of its earnings on August 28. The analyst saying any sell-off is an enhanced buying opportunity. That stock now, in the pre-market, on the session, is down 14%. Dan Ives of Wedbush agrees. It's a buying opportunity. He says this: we're getting inbounds from investors asking us if this tech bull market is over. It's not in our view. This is just a white-knuckle moment in a multi-year bull run for tech stocks that needs hand-holding. Dan, I imagine you're going to give some hand-holding right now. Dan Ives of Wedbush joins us from Japan, of all places. Dan, let's talk about this a little bit more. Why do you think this is a buying opportunity, and what would convince you, sir, to change your mind?
Look, this is the biggest test that we've had clearly in this tech bull market. And I think in terms of what I would need to see to be less bullish, do we see fundamental breakdowns? Now, we didn't see it from earnings. We're not seeing it from our checks in Asia. We're not seeing it in terms of what the demand outlook looks over the next 6, 9, 12 months. And as long as that stays, that's why I believe it's a buying opportunity for the high-quality, large-cap names that we like to buy in these types of periods.
Dan, you're talking about product and services. You're in Asia. I want to know who's been buying the stock and what they've been leveraged to. How much of this tech trade was leveraged to what's been developing in dollar-yen for much of the last year? How much do those two things have in common as they unwind before our eyes this morning?
Well, I think there's definitely, a lot in common. I think we're seeing that unwind today. I mean, look, here in Tokyo, clearly a lot of nerves, that we're seeing in this market, and we're going to see the ripple effect in tech. Now, in terms of what that means for tech stocks going forward, my view is that fundamentally, this is a once in a 40-year cycle in terms of where we see this AI revolution playing out. Now, obviously, these stocks are going to get crushed. When I look at names like Microsoft, you look at names like Oracle, NVIDIA, Palo Alto, of course, Apple, Tesla and others, for the high-quality names that I believe the thesis is there, you own them. And that sort of, and I would just say, in 24 years covering tech, these types of panic periods, the hand-holding, that's proven to ultimately be, I think, the right course for those types of names.
Dan, the lead-in to today, though, did see what some have categorized as a sentiment shift, that the bar has changed for these AI names, that you can't just promise that you're going to see monetization. You need to deliver. And that sentiment change has also been highlighted by someone like an Elliott Management saying that they don't believe in the hype of AI, that it's not going to be as successful that many people think. I know you believe in the fundamental story, but if the sentiment has changed, how challenging does that make it to just be a bull and hold on to it through this bumpy period?
Yeah, I mean, look, I'd say the conversations over the weekend and today, it's a lot more nerve-wracking than it was even 2 weeks ago. And I think going through that period, it's a sort of not just talk, it's walk. Show me the results, show me the numbers. Now, look, those that did a ServiceNow, I'd say maybe Microsoft second half growth, Apple, and despite what we saw with Buffett over the weekend, I mean, those are names rewarded. But now this is going to be a prove me moment for tech. Next 6 to 9 months to show those results, because in this type of market, in this type of risk off, clearly investors are going to head for the elevators with any sort of sniff of bad news.
Well, then it's going to make a lot of people feel uncomfortable that they have to wait until the 28th of this month to hear from NVIDIA. Dan, just what is the bar for them?
I think the bar's actually come down a lot over the last few weeks. But I can tell you what I see here in Asia and what we've seen from a demand perspective, there's no change. I mean, demand has not been the issue. And as long as enterprises continue to line up for AI, and look, we saw Lisa Su and AMD where they're starting to gain more and more share on that front, then this story will stay well intact. But just like we saw with Microsoft going into these numbers, going into this NVIDIA print, I mean, this is going to be, probably one of the most watched prints probably in a decade relative to the nervousness that we're seeing in between these Fed meetings.
Dan, I noticed the beige. I was looking for black. I've got the suit ready for you when you get back to New York, OK? See if things turn around. Dan Ives of Wedbush, just a little bit more somber over in Tokyo, Japan. Just I'm talking about the clothing there. Bit of a difference in the conversation that you're having and the conversation he's having. He's talking about earnings, you're talking about multiples.
Yes.
There's a big difference this morning.
There is a big difference. And that's part of the reason why you can say, the fundamentals are great, the stock is really attractive, but you can still sell the thing just because people have been trading on more of a vibe than an actual tangible thing that these companies are delivering. And if the sentiment has actually changed and we're not willing to wait for companies, it's a little bit harder to say, I'm willing to buy these things on crazy high valuations.
Futures right now, session lows. We're negative on the S&P by 4.5%. The opening bell about 1 hour away. In just a moment, we'll catch up with Andrew Hollenhorst of Citi, making some headlines. Almost straight away on Friday after that payrolls number dropped, Andrew publishes a call for a 50 basis point reduction in September. Stephen Stanley taking the other side of this. That conversation up next. Keep saying take a breath, but no one seems to be taking a breath. This sell-off continues. We're 60 minutes away from the opening bell. Just take a snapshot of where equity futures are right now. We can just sit on it. We're down 4.5% on the S&P, down almost 6% on the NASDAQ. On the Russell, on the small caps, we're down by 5.5. A number of hours ago, Danny, I think people in Europe and Asia were thinking about the US coming in and buying this. It's not happening. It's getting sold.
It's certainly getting sold. The volatility story is getting worse. The VIX in literally just 15 minutes went from 50 to 60. Again, these are the kinds of trades where you picked up pennies in front of a steamroller. And this is what happens when the steamroller arrives.
It's a vicious unwind. Just a vicious, vicious unwind of some big, big trades, including in Japan, which I'll get to in just a moment. I want to look at the 2-year and the 10-year, and we spent some time this morning looking at the difference between the two. The difference between the two was negative 50 basis points at the end of June. And now we're talking about a single basis point. We're down 10 basis points on 10s. We're down 18 basis points on a 2-year. We were down 50 basis points last week at the front end of the yield curve. And we wake up Monday morning buying even more of it. We're down aggressively at the front end of the curve.
We are, and it's kind of the only thing that works this morning, too, the only thing that you can kind of find safety in. And that's when you get to this thing of, is what I'm seeing in the front end of the curve some real signal that I need to take for where the Fed is going to go next? Or is it just the only thing I can buy is bonds this morning? So I have to pile into this trade if I want to see any sort of stability in my portfolio.
There are a lot of calls for some big moves from the Federal Reserve on September 18th. There is a 50 basis point call from Andrew Hollenhorst of Citi. We're going to get to him in just a moment. I want to turn to Japan. I mentioned that briefly. The moves we've seen in Japan, and I think the best way to frame this is think about everything that's happened since 1987. And if you've been around the market long enough, you can go through all of these events through the 90s into the 2000s over the last 20 years. Take your pick. We have just seen the biggest one-day move lower on the Nikkei 225 since 1987. We've had some big shots in markets over the last 30, 40 years. And here we are looking at this move right here.
So many people offsides on this one. So many people so bullish this market, so willing to short the yen. And so that's when you get a day where you have to talk about VAR shocks. You have to talk about positions getting cleared out. You have to talk about margin calls and that being part of the driver. So how much further can it go? Perhaps this is some of the weak short-term hands getting cleared out. But how many people are just structurally short the yen right now? And it takes 1 month, 2 months to really understand your losses. Does that mean that we haven't seen the totality of the pain?
This relationship between the United States and Japan is just kind of one dimension of this overall market move. But it's interesting that the Japanese would be blaming the United States for the move that took place this morning, and the United States would be blaming the Japanese for some of the moves we're seeing in US tech stocks. And we've certainly seen Dan Ives establish that link from Wedbush. Others have done the same thing. Neil Dufter of Renmac, as you and I are speaking, writes in, what's funny about all this is that US yields led the move in JGBs. I'm not sure Japan is the issue. It is the US. And there seems to be a big debate over that right now.
Yeah, but if it is the US, I mean, how does it stop? If we're talking about an emergency Fed cut, if we continue to see yields move lower, that's just going to, again, do this feedback loop where you see appreciation in the yen. So regardless of what side it is, you still have a BOJ that hiked. You still have a BOJ that wanted to see strengthening in the yen. I guess it's, I don't know, be careful of what you ask for.
If you're looking for a circuit breaker, look for some Fed speak. You get Mary Daly a little bit later on this morning from the San Francisco Fed. I have to say the schedule, the calendar for both the Fed speak and the data is really quite light. The one you're looking for is later this morning at 10 a.m. Eastern time when we look for ISM services. And then you've got to go to Thursday for jobless claims. We'll get to that in just a moment. Under surveillance this morning, Berkshire Hathaway slashing its stake in Apple by nearly 50%. Warren Buffett's Berkshire also paring back ownership of Bank of America last month. A second quarter selling spree in stocks, sending Buffett's cash pile to a record $276.9 billion US dollars. And I think the right question to ask this morning, Danny, is how much of that's being deployed over the last couple of days?
Yeah, I mean, if you're looking to deploy some cash, maybe today is the perfect day. Or maybe it's a day where you just want to log off and go to the beach and close your eyes and see what happens in a week's time, because it could get worse from here. I mean, we've heard that from multiple people around this table, that you're not sure it's going to end. But again, for Warren Buffett, I mean, hats off to him. The timing is kind of impeccable.
As you speak, as you say that, there is someone sitting on a train right now, coming back from the Hamptons on Bloomberg Anywhere, listening to this. There's a lot of taps on the shoulder and a lot of get back to work.
Right. Or maybe just hop off on the train, get on the train that goes back to the Hamptons and just, you know, call in sick.
Yeah, good luck with that this week. Goldman Sachs and Jan Hatzius have this to say. They're lifting their recession odds on the United States, but maintain that the risk is limited. Hatzius and the team raising odds to 25% from 15%, but adding the Fed has plenty of room to cut. Goldman's still calling for just 25 in September. Just 25 in September, and they're making the point that actually to call for the 50, you've got to wait until September 6th when you get the next payrolls report. You get another one like the one we just got, it looks like they're going to change their call.
They are very clear on that, as is the Fed. Austin Goolsbee saying that we don't react off of 1 month's data, that we need to see more evidence of a labor market slowing down. The market is not acting that way. 1 month has been enough for it because some of the trend points that way. So does the Fed speak need to change in tone? Does it need to change to one that sounds more accommodative, lest the market run away from it?
Mentioned that 2-year move a few times. That move's now 20 basis points lower on a 2-year, which is just wild, given the move we've already seen on Friday, 369 at the front end of the curve. The calls on the Federal Reserve over the last few days have been wild as well. Traders have been boosting the odds of an emergency Fed rate cut within just 1 week. Friday's disappointing payroll print continuing to rally treasuries on fears the Fed is behind the curve. Joining us now is Andrew Hollenhorst of Citi and Stephen Stanley of Santander. Gents, it's great to catch up with you both. I want to come to you first, Andrew, because you're out with the big call on Friday, 50 basis points in September. Goldman's is sticking with 25. They think maybe you should wait for payrolls to come out for August in September. Why are they wrong? Why is it now the right time to make the call? Why are you so convinced by Friday's data?
Yeah, when we came out with the 50 basis point call for September, we also think they'll go 50 basis points again in November. That was just after the jobs report. And I think that the key thing in the jobs report is not that the unemployment rate rose to 4.3%. It's not 1 month of data. It's that we now have 4 consecutive months of the unemployment rate rising and accelerating. So if the Fed is trying to get a soft landing, you have a lot of momentum upwards in the unemployment rate that you need to stop. If you're trying to stop that kind of slowing momentum, that means rates should be down, maybe at neutral, maybe below neutral. Well, where's neutral from here? Most people would say at least 200 basis points below where we are. So 50 basis points in September is really just getting started. That's why we have 50 again in November. Base case, they don't do this emergency cut, but it's possible.
Possible? What would make it happen?
I think a further sell-off in risk assets and seeing that broaden, right? It can't just be about the tech sector. It has to be broad. It has to be in credit markets, seeing credit spreads widening, liquidity issues. Those are the kind of things that could get the Fed to move early.
Stephen, you're skeptical of that they could go 50, that they're more likely to go 25. Why?
Yeah, I think, well, first of all, I mean, the key thing for the Fed right now is inflation. And I don't think that we've gotten over the hump on inflation yet. We had 4 bad numbers. We've had 2 good numbers. I mean, I did my forecast last month for CPI, and I got 0.3 for the core CPI. I don't think the Fed's going to be cutting dramatically in that sort of an environment. I also don't think the economy's that weak. I mean, Andrew's right about the unemployment rate, but if you look at the totality of the labor market data, it's certainly not signaling that the unemployment rate is giving us an accurate signal of what's going on in the labor market.
But again, as Andrew says, if it's not the level, it's the trend. Is the trend not concerning? Is that not enough for the Fed to step in?
Well, again, I mean, look, the household survey is a very noisy set of data. It's a very small sample. If we were seeing a dramatic pickup in jobless claims, if the JOLTS data were supportive, if all the other survey data that we were seeing was supportive of a dramatic cut in or a dramatic weakening in the labor market, I'd be more convinced. But as it is, I see that as more, there's a lot of noise in that number, in my view.
I want to pick up on your point on inflation. I think it's really important, and it's hardly been talked about for the last few days. We've got the next print on August 14th. Peter Chia of Academy published this over the weekend, and he said if the Fed does anything that looks or smells like they're eager to embrace the Fed put, we would likely see inflation, starting with risk assets. They're caught between a rock and a hard place in terms of being able to be aggressive. Why do you disagree with that, Andrew? Why do you think they're not as constrained as perhaps Stephen and the likes of Peter Chia are suggesting?
There are medium-term concerns about inflation. I'm not discounting that at all. But in terms of the near term, you have financial conditions that are tightening right now, are tightening rapidly, even as we sit here. And if the Fed doesn't push against that tightening in financial conditions, you will actually end up slowing the U.S. economy by more. So what they're dealing with right now is risk management, where, yes, there's some concerns about inflation, but cutting rates now, if they cut 50 basis points in September, that's already priced into the market. That's not going to cause equity prices to rally. They need to over-deliver on what's priced at this point to get equity prices just to stop selling off.
This is where I'm a little bit confused. It was only a few months ago we had people asking whether we needed to hike again. How much of a clear sort of sight have you got on how tight we actually are right now? How do we know that we're as restrictive as you are making out we are?
I think the clearest evidence is from the labor market. That's been our guiding light throughout this cycle and continues to be. If you look at the JOLTS report, for instance, the hiring rate has just consistently been falling below pre-pandemic rates, falling now. If you look at the leisure and hospitality sector in the JOLTS survey, The hiring rate is the lowest we've ever seen outside of 2008. It's lower than it was in 2020. So it is harder to get a job at a restaurant right now than it's been in very deep recessions. That's telling us that we have some real softness there.
Check out this move in the bond market. We've been talking about it for a while. 2-year versus 10-year. The 2-year is down 23 basis points. The 10-year is down just 12. And look at the difference between the two. There is a positive sloping difference now on that yield curve. Danny, I haven't been able to say that for quite a while.
No.
The difference between the two is now positive, a single basis point.
And there have been so many people who have said that when this happens, this is the recession indicator, not the thing being negative, not it being inverted, that it's uninverting that finally causes the recession. Steve, do you want to take any indication from this at all?
I'd like to let the dust settle a little bit. Today seems like not a good day to be taking your fundamental signals. No, I think to Jonathan's point before, I mean, what we really need right now is we need more data. And we do get the ISM non-manufacturing today. The consensus looks for it to bounce above 50. Boy, that would, I would imagine, change the way people were thinking at least a little bit.
Do you think it would put this story to bed? Because we said one of the problems with this week is that actually the calendar for the economic data is quite light. We've only really got 2 points to play with. One is the ISM at 10 and the other is jobless claims on Thursday. Is one strong ISM services print sufficient to put this to bed? Or do you think the mood this market's in will just ignore strength and embrace weakness for the rest of this month?
Seems like an awfully strong panic mode this morning, so I don't know. Maybe. We'll see.
Andrew, this is tough, and I think this is what everyone's got to sort of embrace and confront right now through the next couple of hours and through this week. How sensitive this market will be to incoming data, strong data, and weak data alike.
It's a really difficult moment. It's a really difficult moment for the Fed. Danny said it earlier. You have the market that started responding to the economy. Now you're going to have the economy that's responding to the market. As these financial conditions tighten, it actually raises further the probability that we're in a recession right now or that we'll soon be in a recession.
Could we get an inter-meeting cut then if this thing kind of snowballs?
That's the question. I think you do need to see more here. I don't think this is enough for an intermeeting cut, but that has to be something we put some probability on at this point.
Stephen, any probability of that for you?
Not unless the world absolutely falls apart.
You're not impressed by these calls at all, are you? You really think this is just a panic that could be over pretty quickly? That's what it sounds like. Is that a fair sort of characterization?
Yeah. Yeah. I mean, look, the Fed is going to be easing soon. In my mind, you know, more likely than not now September rather than November. But and I think once they start to go, they're probably going to be going in a series of moves. But I just don't see the need for a kind of a panicked rush.
Would they still call this a mid-cycle adjustment, do you think? Or would they tell us they're on the path to normalising, on the path to getting accommodative?
I think it's a path to normalization, but whether that leads ultimately to accommodative or not, I think remains to be seen.
Andrew, how do you think they'll frame things?
I think I agree with Stephen there that they will see this as the need to normalize policy rates. At least that will be the first move here. Now, it might move to a need to move to accommodative. We've heard from Chair Powell, they think rates are restrictive here. And I guess that's my broader point this morning. Why would you be restrictive when the equity market is selling off and the unemployment rate is rising? You wouldn't be, so they'll be looking pretty quickly to move rates down towards, at least 3%.
But if we want to live with the philosophy, if the Fed should do the least damage in this scenario, is hiking aggressively or before September not doing damage in terms of them signaling we're worried about something, that there is an emergency?
Yeah, I think that's exactly what they need to negotiate here. And I think you heard that tension from Chicago Fed President Goolsbee on Friday, not wanting to sound like they're over-responding, not wanting to spook the market further. But the reality is the sentiment is shifting, and it has shifted, and they'll have to respond to that.
But see, Stephen, that's why I wondered, to your point, why there can't be something bigger, because it feeds back on itself and you get that negative wealth effect. You get conditions tightening, maybe more than they should, which gets a bigger reaction from the Fed.
Yeah, well, I mean, this has been one of the problems for the Fed all through this cycle is that financial conditions have been easy, right? I mean, they raise rates, they talk about how policy is restrictive, but if you look at broader financial conditions indices, they've all been very easy up until, the last few days. And now we have to weigh deterioration in risk assets versus the big rally that we're seeing in interest rates. So I think they're certainly cognizant of that, but I think the underpinnings for the economy are still pretty solid. And the one problem that this economy has, conceivably, is that Fed policy is super tight, and that's something that's very easy to fix. So we'll just see whether that comes fast or slow.
As of last week, Chairman Powell agreed with you. I just wonder how much has changed since Friday. Andrew, do you think if they had that information to hand on Wednesday, we would have seen a different decision?
Yeah, I think we would have seen a cut on Wednesday if they knew this was going to be the jobs report.
Amazing. Andrew, thank you, sir. Andrew Hollenhorst of Citi, Stephen Stanley of Santander. To the two of you, thank you. I just want to get you an update on some of the price action as we sort of guide you towards the opening bell, which starts in about 45 minutes to kick off another week of price action. I want to actually start in the bond market and not in equities. Bonds here, yields are lowered by more than 20 basis points on a 2-year at 366, on a 10-year at 368. So we actually have a 2-year below a 10-year for the first time since the summer of 2022. That is quite a change, and that is quite a rally at the front end of the yield curve. As we talk about bonds, equities are near session lows on the S&P 500, down by more than 4 full percentage points on the S&P. So if you thought that was over on Friday, you're waking up this morning scratching your head and you've got a big headache. This is a big move.
And I think you put it so well that during the Asia trade, people were waiting for Europe to come online and then the U.S. to come online and save something. Instead, what you got was a more than 12 percentage point drop in Japanese equities, the biggest since 1987. I think we're just grappling with the side effects of that, of how many trades were stacked on top of each other, how many trades really were contingent on a weaker yen that now have to undo themselves. And again, it just keeps bleeding through globally, markets, be it again, Asia or here in the U.S.
The Fed is not willing to step in at this point, based on the officials we've heard so far from. We heard from Austin Goolsbee of the Chicago Fed. Mike McKee sat down with Goolsbee on Friday. Goolsbee basically said, give me more data. Give me more data. I'm not ready to make any assumptions about what we do come September. He implied they reduce interest rates, but there's none of that panic in their voices compared to, and I will use this word, the P word, compared to the panic we're seeing in the bond market.
Right. Well, you have a market pricing in an emergency cut. There needs to be an emergency for there to be an emergency cut. What's the emergency this morning? Equities selling off some 5%. It's hard to argue that that's enough for them. It needs to be something bigger.
Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hakez. Hey, Yahara.
Hi, John. Oil is following equities lower, extending its losses to a new 7-month low. West Texas Intermediate is trading around $72 a barrel, while Brent futures are trading below $76 a barrel, erasing this year's gains. This coming as the market braces for a possible attack from Iran and regional militias against Israel in retaliation for assassinations of Hezbollah and Hamas officials last week. We're also seeing cryptocurrencies getting crushed. Bitcoin dipped below 50,000 earlier this morning. The drop adds to a 13.1% drop last week. That was the worst since the period when the FTX exchange imploded. Meanwhile, spot Bitcoin ETFs suffered their largest outflows in about 3 months on Friday. And U.S. candy giant Mars is considering buying snack maker Kellanova in what could be one of the biggest deals in the consumer industry this year. That's according to people familiar with the talks. Kellanova spun off from Kellogg last year as part of a restructuring and includes brands like Pringles, Cheez-It, and Pop-Tarts. The deal would link those brands with Mars staples like Snickers, M&Ms, and Skittles. Kellanova shares have gained over 12% this year, with the company valued at over $21 billion. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Thank you very much. Up next on the programme, we'll set you up for the week ahead and the day ahead as well. That's up next. You're watching Bloomberg TV. The opening bell is about 40 minutes away. Price action, there's a lot of it. Let's get to equities first. On the S&P 500, down by more than 4 percentage points. Not a typo. Doesn't need correcting. That's where the market is right now. In the bond market, yields are lower by 11 basis points on a 10-year to 369. On a 2-year, down more than 20 to 367. Just unbelievable price action. I would like to get you the trading diary, just the flavour of the day to the earnings and the Fed speak for the week ahead. And we'll start with 10 a.m. Eastern Time. In 1 hour, 10 minutes time, the ISM services data, one of the biggest data points of the week. That is the one to watch right now. How vulnerable is this market to getting whipsawed in the other direction? Or will it just be reinforced by weaker data all over again? Look out for that. Plus, we get some Fed speak picking up with San Francisco Fed President Mary Daly. Tuesday, U.S. trade balance plus results from Uber and Rivian. On Wednesday, more earnings from Disney, Warner Brothers Discovery and Lyft. Thursday, your next big data point, another round of jobless claims. Plus, more Fed speak from Richmond Fed President Tom Barkin. Mike joins us for more to break this down. Mike McKee, we are light on data, we are light on Fed speak, but let's talk about the data that we will be getting that we do have. ISM services at 10 a.m. Eastern Given where this market has been and given what it's doing, how important is that data point going to be?
It's going to be very important psychologically, if nothing else. If we got a bad number, if it's still contraction, we had the first contraction in ISM services in months for last month. If we get another contraction, then people are going to be, opening up the windows down on Wall Street and ready to jump out today. We'll look at the underlying numbers as well and see what it says about employment, and if that backs up the idea that the labor market is falling apart. Then you got to wait till jobless claims. I mean, that's going to be the only other number that's going to matter this week. And we know July is often distorted by seasonal adjustment factors, so it could go either way. They could fall. If they fall, then everybody who is jumping out the windows is going to be reaching for a parachute.
Mike McKee, you heard from Andrew Hollenhorst. He's looking at 50 September. Mike Ferroli, JP Morgan, looking for 50 September. I'm sure there's another part of this conversation that's bugging you a little bit. The intermeeting calls.
Yeah.
An emergency rate cut from the Federal Reserve. You've been around the Federal Reserve a long, long time. When you see those things coming up in markets, what's your reaction to it?
The Fed doesn't cut rates because stocks fall. The Fed does emergency moves when the stock market ceases to function or the bond market ceases to function, when people can't make trades. And right now, there's no sign of that. They're not going to worry about the fact that you're losing money because maybe you got out over your skis somehow. Danny put it very well earlier about, the Fed would cut rates in an emergency, but what's the emergency here? It's 1.5 days of bad equity performance. There's a lot of signs that things could get better from this, in the sense that, yes, you balance off the wealth effect, but you also have gasoline prices falling, you have mortgage rates falling, you have some stimulus in the markets already from the reaction to all of this. So the Fed has to weigh all of that, and they don't want to get back into the business of these emergency cuts and going back to zero in the Fed put.
Just that point, you spoke to Austin Goolsbee on Friday, a very calm Goolsbee, talking about it's just 1 month. We need to see more months. Is there any sense that a market overreaction could change that kind of calm tone from the Fed?
It would have to be sustained, and it would have to be, really deep and really threaten a wealth effect issue or threaten corporate confidence so that companies want to start laying off people. Recessions are really psychological events, and we haven't seen that from anybody but the equity investors at the moment. If it spreads to a broader economy, then the Fed might want to do something like that. But they're going to wait and see. As somebody pointed out this morning, in January, we were pricing in 6 rate cuts.
Yep.
Now we're pricing in 6 rate cuts again. The Fed has not changed its view pretty much for the whole year.
Markets changed a lot.
The markets change all the time.
Danny asked the question earlier. I think it's the right question. It's a really good question about the labour market. Weather. We were really surprised on Friday to see it sort of explicitly mentioned that this wasn't about Hurricane Beryl on Friday. Where are you on that? Just how weather impacted this labour market, or rather how weather didn't impact this labour market?
Well, somehow weather impacted the labour market. Whether it was the hurricane or not, we don't know. There were over 400,000 people who couldn't go to work because of weather, which, if you added that back in, obviously would have made the numbers a whole lot different. A lot of people working part-time because of weather. The BLS says it wasn't because of the hurricane. We don't have any data that would argue with it. In the middle of the month, we'll get the Texas unemployment figures for the month, and we'll see if they bear that out. But at this point, there's a very good chance we could see a snapback in the August numbers when we get them at the beginning of September, which is another reason the Fed doesn't want to panic. And remember that the error band for jobs is 130,000. So this could be, a negative. July could have been a negative number, or it could have been over 200,000.
We'll see where we are this time tomorrow morning, and tomorrow morning feels like a long, long way away. 10 a.m. Eastern Time, the next stop for this market. ISM services, that is a big, big data point, about 1 hour and 4 minutes away. Equity futures, session lows, your lineup tomorrow. Katie Kaminsky of Alpha Simplex, Jim Karen of Morgan Stanley, Tim Tsouras of Strategas, Christina Kampmany of Invesco from New York City. This was Bloomberg Surveillance.